Okay, everybody's getting on, getting situated in offices all over the country today. I'm not sure if New York is on. I know that they have a whole different set of rules with their life course, and but the rest of the country's on. We have 3 trainers today. We have the great Michael Coleman, which I'm the most excited about because Michael actually created this course, and he's been teaching it. He's been teaching it out here in Southern California, and people have been driving to go to this course from all over the place. And we just thought, you know what, we're going to make it so that it can be offered in every office at least once a month. So hopefully today we have people that are on that are unlicensed, getting ready to take their test, and we have people that are watching this in order to be able to teach this class. Now, the first thing I want to say, this is a crash course, but you know, don't expect that you're going to come to this course and be 100% prepared to take your test, okay? So the state requires a 52-hour course, and hopefully you are all enrolled in that. My suggestion is at the end of that course, there should be practice exams. Probably if you're taking a decent course, it probably has at least 3 different long practice exams. And you need to be getting 90% on those practice exams to be able to pass. So actually it's about an 85%, but I recommend getting 90% on all of those to pass. So if you're getting less than 85% on your practice test, do not take your test. You're not ready. But hopefully today we'll explain some concepts that you can now, when you're taking the practice exams and when you're doing all of your studying, you'll understand what these concepts mean, which will then lead to the conclusion that you have the right answer and you know why you got the right answer, and it will speed up the process for you to be able to take your exam and pass. So our goal is for you to learn as much as possible in the field and in the classroom, practical training, theory, and then as well as studying and taking your test. There is no reason to take a test and pass a test because you're not going to make any money. You're not going to make any money if you don't know how to use that license. So a doctor could have a license, but if he has no practical knowledge, he's never done any internship or anything, you don't want that guy to be your doctor, right? So same thing here. You could have a driver's license, but you don't know how to drive a car. You're not going to go anywhere. You're going to be dangerous. So here we want you in the field, a ton, like 10 at least real world practical trainings while you're studying and taking your test. On the other hand, though, do not put off payday. Get that license as fast as possible as well, together, same time. So again, we have Michael Coleman today, and we have Russ Coburn. And so we're broadcasting all over the country. Right now, Russ, I believe, is in Pasadena office, and Michael Coleman is down in Florida in one of our offices there, and just wrapped up with those guys. I'm here in my Thousand Oaks office, and super excited to be with everybody today. I do want to, again, just thank Michael. He's going to start off this training, but thank him for all that he does for so many people. He's changed thousands of lives with clients, but also teammates. He's a great visionary, but he's also just very good at learning the things that he needs to learn to become a better leader, a better trainer, and then also to be able to help you guys. So Michael, it's funny, I was talking to one of my guys the other day, and he said, you know, I'm a great, recruiter and builder, but I just can't learn how to do the financial side. And I told him it's because you didn't take the time to learn. Michael, myself, Russ, none of us knew this stuff coming in. We were just like you. I worked at Bally's Total Fitness Health Club. I didn't know anything about leadership. I definitely didn't know anything about financial planning and insurance, but we took the time to invest it in ourselves to be good at what Napoleon Hill calls that specialized knowledge of our field, so that we have confidence. So the license, again, is just to be able to make money. The field is to gain that confidence, and Michael Coleman is the best at both. So we are so lucky and so grateful, Michael, that you put all this together and that you're here with us today. So I will turn the first portion over to you. Oh, can't hear you.
Just kidding. I'm just joking around. Anyways, I am so excited to be able to teach this class. One of the things when I first got into WFG. One of the things that blew me away was that Jamie, at her level, which at that time she was executive marketing director, making about $250,000 a year, she took the time to actually, make sure that I was studying and that she sat down with me. And I remember I was driving to my exam, and she called me at 7 o'clock in the morning going, okay, well, I'm going to help you. And, here's some questions. And what does this mean? And what does that mean? And what that did is it really put into my mind that I needed to be a really good example of like actually helping my guys get through licensing. And one of the things that we don't want to like over acknowledge, like getting a license, like anybody can get a license. You have to apply yourself and study. But also at the same time, I was like, the number of licenses that I have in my organization is going to dictate how much we can produce and how many families we can help. And if you were to ask yourself a question like, would you rather have 3 licenses on your team, or 300 licenses on your team, or 3,000 licenses on your team, then you would start to conduct yourself a little bit different. You would be driving your recruiting numbers. You would be, really getting after it. So this has always been one of the things that are most important to me, is making sure that we have a high volume. And this is part of my business philosophy and team identity, is that, number one is that we need to build leaders and teams will come. Number two is that we must focus on the number of licensed and effective field trainers that we can have that help, that we have that help families, right? The number of licensed and effective. So getting like exactly what Jamie said is that you could have a license, but if you don't know what you're doing, that's not good. But then we also have people that are also, they're very effective, but they don't get their license, And so we want you to do both. And then the third thing that I've always taught is, my business philosophy is that, it's the golden rule in everything. Treat people right and you'll do okay. So you want to be able to always, treat people right, do unto others as you would have them do unto you, and apply the golden rule in everything. And these have been guiding principles in, in building our organization. So getting back to it and going through the life insurance crash course that we're going to do, exactly what Jamie says. The goal is not that we're going to try and get you to be super professional in all of this stuff. It's to get you a familiarization with the terms so you can understand it, and then also give you some context and understanding of like why we're doing this, a little bit of the crusade and where we're going to be going ultimately with this. And then ultimately, I want it to be that all the senior marketing directors and the leaders in this webinar are teaching it, with the same level of intensity and energy and sense of urgency. Because I found that, in the past, and, I'm guilty of this too, is that we would have people that are fairly technical and they don't really have a huge amount of field experience going through and reading these slides. And I'm sorry, but that just doesn't work. I like to be able to give a lot of examples. I know that Jamie has a lot of, real life examples of how these things, stuff from like death benefits to living benefits, like these things have actually happened in our agencies. And so we're going to give you some really good, practical, real world understanding of how these concepts work. But the best place to get it is out in the field. So I would encourage you. And again, if you're teaching this class in the future, that you really make sure that people understand that there's a huge crusade. We're not just getting these licenses for the sake of getting licenses, but every single person that we wind up helping get a license now has the ability to go out and help families, which is awesome. The second thing is that, we want to be able to have a good duplicatable licensing system. And so that's what I know in talking to Jamie, the other EBCs, and, and Russ, and all the other SMDs, is that we want to be able to have a really, really duplicatable system so that we move from, where we're at, which is, at Team Revolution, I don't know, we're at 3,000-ish licenses or something, but we want to go to 6,000, 10,000 licenses, 20,000 licenses. And then we're really going to be making some huge, moves in the industry. And, you guys should be very excited about that. So I'm going to get into it and give a little bit of context. I'm going to turn it back over to Jamie. And then she's going to go through, the first set of stuff. But I'm going to share my screen, and then, by the way, at the end we'll show you how to get these slides and so forth. But let me go ahead and share my screen right now, and then there we go. Russ, can you give me a thumbs up that you can see the screen?
Yeah, we're good, Michael.
Perfect. Okay, so I'm going to go through and just cover just the intro part, and then I'm going to turn it back over to Jamie. So the first thing that we're going to go through here is that you can, number one, you can take the exam without completing your online hours. However, you will need to finish your hours to get your license. So don't screw around with this. Is that if you were like, okay, well, I want to go and just take the exam, you could do that, but you still have to go through the certification and getting the actual certificate of completion so that you can get your license. So I'm just gonna tell you, some people have been very gutsy and they said, you know, I'm just gonna run out and take my exam, and then they did it, but then you still have to go through and actually turn in the certificate that you're gonna get as a result of finishing this. The test is computer-based. It's life and health exam. It is 150 questions. It's all multiple choice. Now, I'm gonna tell you this right now. I always encourage to do life and health. The reason being is that we've got some incredible hybrid products that need both licenses. So you can have like a long-term care plus life insurance, but if you don't have that, you can only sell the life insurance product. So I encourage you to do the 52 hours in order to be able to get that done. You also need 60% to pass the exam. So if you got a 60% in, school, you know, that is not barely even a passing grade, is 60%. But here, that gets you the license, you know? And so I'm telling you this right now, it's not as difficult as you think that it's gonna be, right? And so you need to be scoring in the 90s in your practice exam. And if you're in your 90s on the practice exam, you're gonna ace this test. Here's the other thing too, is that I would encourage you, when you go in to take your exam, and put this in big, huge letters in your notes, is that you have to have a positive attitude. I think that, you know, most of the time when people fail, it's because they had a bad attitude going into it in the first place. They're going to say stuff like, oh man, I didn't study that much. You know, I should have, you know, put in more time, and maybe I don't understand these things, and I should have gotten the field. And they're literally second guessing themselves the entire process. So I want you to understand that when you go in to take your exam, you need to leave your baggage at the door. And everything that you go into is, man, I can do this. This is awesome. I'm going to be able to pass this exam, so that you're at least going in on the right, foot as far as your mentality. So what's the income potential? You know, what's the income potential? Well, let's show you what you can potentially get with this license. And by the way, I just want you to understand that these are my notes from going through. The other person that helped tremendously was another, one of our SMDs is Aaron Tarabian, you know, helped put together these slides. So Aaron, thank you so much for helping and assisting with that. But these are essentially our notes. You know, this doesn't get you any hours. This isn't anything official. This is just one agent sharing their notes with another agent. That's what I want you guys to understand. You know, we're all independent contractors here, and we're all just, going through the process of being able to get licensed. And so we're all here just, we choose to be here. And this is just me as an agent sharing my notes with you. So if you look at this, one of the gentlemen that you'll see on this slide is a gentleman by the name of Swan Nguyen. Swan gets paid about $1.5 million a month. He's the highest paid active agent in the US, meaning that he's still out in the field, still developing leaders. But I want you to think about that. Most of his income comes from the life license. Most of his income comes from the life license, right? So that's amazing that you can have someone making 18 million bucks a year, and that, you know, he's got the life license, which is the same license that you're going to get. Alicia Nguyen, she's another one. She's at $1 million income. She's 28 years old. And that's another thing that she got, is that most of her business is with a life license only, you know? And so think about that. That's amazing that she's at that level of income. And, it's kind of funny because she's Swan's daughter, and everyone's like, oh, Swan gave her, a bunch of stuff. No, that's 100% not true. She built it. I'm on the board of directors with her at Transamerica. She's awesome, right? But can you imagine at 28 years old with the license that you're going to get? Most people that are 28 years old are still just trying to figure out how to get out of their student loans. And she's already making $1 million. So this license is going to be way more, potentially more valuable than than getting, even going to college. So, and then the last one, and by the way, I'm not encouraging people not to go to college. I'm just telling you that it can be a really valuable thing to get rid of that college debt if you're making tons of money with this license. Then the last one is Tita Lizon. Tita's a good friend of mine, and she is a former nurse. She doesn't speak that good at English, and she makes $500,000 of annual income. And I asked her once, I said, Tita, how many clients do you have? She goes, 4. And I said, oh, is that like 4 a week, 4 a month? Are you doing like, how often are you getting? She's like, no, I got 4 clients. And I was like, how do you have 4 clients and you're making $500,000 a year? She says, because I basically bring them to my leader, they do all the sales, and then they split it with me. So as a split sale referral agent, she's making $500,000. That's just crazy. Guys, so when you're going through this license, I don't want you to be thinking like, oh my gosh, this is so tough and I've never studied this before and, maybe I'm stupid. Don't say any of that stuff. Remember what you're doing is that once you get that license, it's a ticket into the game, right? And then you can just go run as fast as you can, get your promotions, talk to your SMD, set some goals. It's going to be amazing. So things that you can do with, your life and health license is that we can do everything here is that we can do life insurance, long-term care insurance. We can do retirement plan rollovers. We can do health insurance. We can do group health insurance. We can do 401k plans. We can do something called executive bonus plans, and basically that's helping executives to bonus out their staff. The rest of these things are self-explanatory. For businesses, we can do group life insurance policies. So there's tons of stuff that we can do. And I'm going to tell you this, about 80% of the products that we do, you can do with your life and health license. So that's awesome. 80%. About 15%, you need your securities license, and about the remaining 5% is all of your advisory licenses. So I'm going to tell you this right now. This license, you can actually get all the way up to CEO and executive level promotions with this one license. So don't take it lightly. This is your key into the big time. Okay, so our outcome is to give life and energy to the material so that you're not bored, right? So we're going to give you some life. We're going to show you some stories and talk to you about, some ways that this stuff has affected us. It's also to familiarize you with the insurance industry terminology. I don't know if you've ever been to a foreign country where you don't speak the language. Sometimes you can feel like you're an outcast and you don't, and no one's understanding you. I know how that can feel. So this here is going to get it so that you have conversational insurance ease, right? You're going to be able to speak conversational insurance so that, you can actually get through the test. So we're also going to give you, like I said, practical and real life understanding of the material. You can tell a couple stories here and there, how these things have happened, and our also is to help you pass the test on your first try. One of the things, and I think that, that I'll tell you this is, okay, so here we go. So please, put your phones on silent or off. Again, if we're teaching this in a group environment, and by the way, in our offices, we should be going through this. Sometimes the spouses, I know that Raj Dhaliwal has the spouses teaching this class, and because they wanted to be able to contribute. But whoever it is, they got to be fired up. They got to have some field experience. They got to know what they're talking about. They have to be one of the, leaders as far as, production and recruiting, to be able to do this. Ask us questions during the class. There's no such thing as a stupid question. Now, obviously, we can't take questions on this, but in your offices, you're going to be able to ask questions. I always say there's no such thing as a stupid question. Just stupid people who ask questions. Just kidding. I'm just joking. That's a joke, right? So the stupid question you don't ask will show up on your test, and you want to have high energy and total focus. So the last thing that I'll tell you is this, is that when I went to go take my exam, Jamie told me, she says, listen, Coleman, she goes, you got to drink your orange juice. And I said, what do you mean? She goes, before you go to take your test, you need to drink orange juice. And I said, okay. Why? She goes, because it helps your brain synapses fire faster. And I was like, I don't think that that's true. But if my coach says that I got to drink an orange juice because it's going to make my brain work faster, then I'm going to drink the orange juice. So I went in, I grabbed my orange juice. I remember walking down the street at 300 Spring Street, drinking my little OJ. I walked in and I passed the test. Before every test, now it became sort of like, one of those rituals, like a baseball, superstitious ritual. Before every test, I always drink an orange juice and then I pass the test, right? So I'm just telling you, before you go to take your test, this is just a couple of points, and mark this down in your notes. Number one, get rest the night before. Do not all-nighter it, because here's what happened. Most people fail because they're sleepy on the exam. Get a tremendous amount of rest before you go in there. Have a decent but not tiring breakfast. Don't eat a stack of 10 pancakes before you go take your test. Eat something very light, just a single orange juice. That's what I took when I took my test, right? Go in with a positive attitude, high energy, and total focus, and you're going to do just fine. So with that being said, right, I want to tell you that, you know, she's our coach, and just so much vision. And I see that what she wants to do is she wants to help us to be able to win, and she wants us to win at the highest levels. So I want to, you know, to tell you, you know, that she's she's not just a great friend as a friend, but she's your great friend because she's taking the time out of her schedule to be able to do this and to help us win at the highest levels. And so I just love the example that she sets, and she's just an amazing, amazing leader. So Chief, I'm going to turn it back over to you, and she's going to take over this next little bit here. So thanks a lot, Chief, over to you.
Awesome. Thanks. Can you hear me? Good. Okay, so I'm going to click through here. Oops, we're going to share the slides. All right, so we're going to start off with the life insurance portion, and then we'll move into the health insurance portion, and at the end there's a little bit about annuities. This is mostly life and health, but because of index annuities now, you will see some of it on your test. Just remember on your test, if they ask you about retirement plan, if they say anything about retirement plan, some of the answers might be a life answer or a IRA or something like that. They're not talking about securities. This is not a securities exam. So if they say retirement account, the answer is annuity. Okay, so you just got a freebie right there. All right, so we'll start off with the life insurance stuff. And pretty simple once you understand this stuff. It's all new terminology, but indemnification. So indemnification means to make whole. So to make someone financially whole again. So we use the example of you total your car, you get in a car accident, they total your car. The insurance company, you have insurance, they're going to make you whole again. So they're either going to fix your car, or if it's a total loss, get you a new car. So you are indemnified. In life insurance, what that means is the husband dies, we can't bring back the husband, but we can replace the income loss. Does that make sense? To make that family whole again. That's the purpose of life insurance, is to indemnify the people that need that income. Okay, so hopefully that makes sense. That's going to be on the test. Insurable interest. There has to be insurable interest when you buy life insurance. So I can't just be like, I'm going to buy life insurance on that guy because he looks like he's going to die soon, so I can get rich. Makes sense? So there has to be an insurable interest. So if I, as a husband and wife, is there insurable interest? Yes. Children? Yes, because I have to pay their funeral expenses. How about if I'm business partners? Let's say Hannah and I are in business together. It's a small business, and if she dies, I don't want to be in business with her husband, David. So I have a life insurance policy on her that pays me. Maybe that's a bad example, but you see what I'm saying. Two business partners may have insurance on each other because they don't want to have, they want to be able to buy out that spouse and now be a sole proprietor. Does that make sense? Or another insurable interest could be like, I'm NBC and David Letterman is my big cash cow that brings in a ton of money. I may have a policy on his life because if something happens to him, I need to either replace the loss of income that he brings in or replace him in general. Make sense? So as long as there's an insurable interest. Now, the most important part, it might be on your test, insurable interest only has to happen at the time that you're buying the policy. So I may be in business with Hannah now, and I buy the policy on her now, but then we're not business partners 10 years from now, but I can still have the policy on her. So there doesn't have to be a remaining insurable interest, only at the time of purchase. Okay. Let's see, in property and casualty, you must have insurables both before and after. Okay. Got it. All right. Insured, policy owner, payor. Okay, so once you actually pass your license, this is something you might actually use in the real world. So the insured is the person who's you're writing the policy on. So your client, that it's their life. If they die, if the insured dies, then the death benefit pays out. So that's who's the policy is written on. Okay, now the policy owner could be someone else. So let's say I'm buying a policy for a child. I'm insuring the child for $10,000 to pay for funeral expenses or something. The child is the insured. The policy owner is, let's say, the mother. The payor could be a completely different person. The payer is the person who pays the premiums, the cost. So let's say the child is the insured. The policy owner is the mother, but the insured, the payor is someone who's paying the premiums. So that could be the dad or the grandma. Does that make sense? Okay, so let's say the grandma says, I want to pay for my granddaughter, whatever, Insured is the granddaughter, grandma is the payor, mom is the policy owner. Why would there be a different policy owner than payor? It's usually the payor is the owner, but it could happen. It happens in cases where minors or children, but it happens in other cases too. For example, the case with me and Hannah being business partners, she is an insured, maybe on her life, the payor may be our corporation. It could be, you know what I mean? That could be. Now, the beneficiary is a person who receives the death benefit. So when the case of death, the beneficiary is the one who receives the $100,000. Does that make sense? So again, that could be the policy owner. The beneficiary could be the policy owner. So again, let's say again that the insured is the 14-year-old Daisy, my daughter. Okay, I am the policy owner. My mom says I want to pay for it because I want to have something for my daughter and for you and whatever. I believe in life insurance. So Grandma Tony is the payor, Daisy is the insured, I am the policy owner, and then the beneficiary is myself or my husband or our estate plan. Does that make sense? Our living trust could be a beneficiary. Whoever receives the money is the beneficiary. Beneficiary could be charity, a charity that it goes to. It doesn't even have to be a person. Does that make sense? And we're going to talk more about beneficiaries, but I just want you to understand those main concepts. Everybody in this room getting it so far? You guys can be a good gauge if there's something that you're totally confused on. Let me know so everybody else because I can't talk to them, you know, if they have questions. Okay, premium and risk. So a premium is the money that the insurance company receives to take on the risk. Premium is the $300 a month that the cost for the insurance, or the premium could be made monthly, it could be quarterly, it could be annually. You can pay premiums lots of different ways. But what's the risk? So the risk is the uncertainty that loss may occur. So like there's speculative and pure risk. So speculative risk could be potential for a gain, like gambling in Vegas or betting on a football game. Gambling is speculative risk. Now, I have seen this on a test. Okay, pure risk does not have to have a potential for a gain, but there is a potential for a loss. So what is the potential for a loss? Well, why do you buy life insurance? Again, to protect against that risk. Now, no one wants anything to happen, but God forbid something does, where the breadwinner is gone and now there needs to be compensation to that family. So there's a risk against death. That's the risk that the insurance company is taking upon itself, that how risky is it this person is likely to die. That's why cost of insurance is more expensive if you're sick, because there's more risk to the insurance company. So it costs you more premium. Make sense? Okay. So when buying life insurance, you are transferring the risk to the insurance company. Same thing when you're buying like auto insurance. Again, this is not a PNC test, but just so you understand the concept of it. When you're buying auto insurance, you're transferring the risk. If someone hits you, then you don't have to come out of pocket. Does that make sense, guys? Understand these two concepts? Pretty clear? Okay. All right. So, Michael mute himself. Oh, Mike, can you put yourself on mute because we can hear you like kind of moving papers around or something? Okay, so beneficiary. Beneficiary again is the one who receives the death benefit. Now this part, I'm going to give you one that maybe the rest of the teachers don't like me saying, but remember what the beneficiary is, right? It's the guy who receives the death claim when someone passes away. So there's different ways that they can receive it. Per capita or per stirpes. Okay, so let's say my husband and I are married, and he's my beneficiary, and I'm his beneficiary. But what if we died together? And now it goes to the other beneficiaries. Or it could just be, your primary beneficiaries too. But can you text Coleman? I don't think he knows that you can hear him. Like you can hear him shuffling papers. Okay, so the per capita means per head. So think of cap means, think of decapitate, dehead. That's how I remembered it to pass my test, right? Per head, decapitate, cap. Okay, so per head. So if I have 4 kids right now, and they're named equally, 25% each if I die. Okay, my husband and I are both dead, right? So they get 25% each. Okay, now this kid dies with us in the car accident. Sounds so morbid, but now here we have 3 left. Who gets his 25% share? Where does that go? Does that make sense? Mm-hmm. Where does that go? So me and my husband pass away. This guy's gone. Per capita means his 25% gets split per capita, per head, per these 3. divided equally amongst these three. Per stirpes is not per head, means this guy's beneficiary. So this son that passed away, it goes to his heirs. So it gets passed on. How I remembered it, this is what they're not going to like, per stirpes, per herpes, it gets passed on. You'll thank me when you're taking your test because you'll remember which one's which. It gets passed on to his heirs. It works. Okay, y'all don't have to teach that way, but I always do because they remember it. Okay, hazard versus peril. Hazard is something that could increase the chance of loss. Now you've seen this. There's a hazard in the road. There's a pothole in the road, right? One of the first policies I wrote was a referral, and they were declined because of a hazardous occupation. She was a dancer at Spearmint Rhino. So she was declined. So speeding is a hazard because it could cause a loss. You have a dangerous occupation. You're a skydiver instructor or something. That's a hazard that could cause a loss. What does that mean? It means you have higher costs of insurance. Yes? Peril is the actual cause of loss. So let me explain now. There's faulty wiring. That's the hazard. The fire was the peril that it caused. Does it make sense? The pothole was the hazard. The car accident was the peril that it caused. Got it? Makes sense? The two different things? See, once you understand these concepts, it's real easy to get the questions right. Now, contingent, we're going back to beneficiaries. The word contingent in life insurance means secondary. So me and my husband, he's my primary beneficiary. If I die, he gets 100% of the money. But if we die together, we have named contingent beneficiaries. So contingent, second in line. If he's alive, they get 0. He's dead, now I've named my contingent. Make sense? So that's all it is, secondary. Okay, Coleman, you want to take over on this part real quick? Oh, he's not on it? Okay, well, then I'll just keep going. So the appointment is in order to, now I don't know how much of this could be on your test, but it might be. Okay, so, and it's also real world stuff. So once you've passed your test, you have to get what they call appointed. So appointed is in order to sell, you have to be appointed with an insurance carrier. So these are some of ours: Transamerica, Voya, Nationwide, Allianz, Pacific Life. So just because you have a license does not mean you can sell stuff or write business. You have to get appointed, and the carrier can choose to appoint you or not. So even though the insurance company or insurance commissioner gave you a license, Pac Life might be like, nope, we don't like him because he has too many chargebacks or whatever. So you have to be appointed with the company. Usually you just fill out stuff. If you're not appointed, you're considered an inactive license. So on the Department of Insurance website, it will show that you have, but you're not active with any carriers. A captive company, you can only sell one product. So we are not a captive organization. You can sell multiple products. But let's say I work with New York Life, I can only sell New York Life. It's a nice thing when you're out of test world now. Let's say when you're talking to a client, we're not captive. We represent a lot of different carriers so we can help you. Okay. Next, representation. When you're buying life insurance, your answers are representing you. They cannot be altered or withdrawn, like only before the policy's in effect. Afterwards, they cannot be altered. Like, oh, yeah, I actually did smoke. I need to change that. You can't, it's like whatever you represent yourself, don't lie, because I'll go into that next. So the word material in life insurance means important. All material information should be disclosed to your client. If not, like omitting material information is the same thing as false representation, right? You can't lie, you can't give false representation, but omitting material information is information is the same thing. Same thing on the client's behalf. Like, they have to say, they have to be honest, and they have to include all stuff like I smoke, I had cancer 5 years ago. You can't leave out that material information. That's important. The right of rescission. Life insurance is a contract. If either party of the life insurance company, the other party can cancel, whatever. So it says basically the right of rescission. The insurance companies have 2 years to rescind stuff. So for example, someone did lie, or they omitted something, like they smoked or something. Within 2 years, if they find out about this, they can rescind it. They can basically, there's a contestability period for 2 years. After that, like, you know, they can cancel you, and if they cancel you, they can send the money back, like the premiums back. Yeah. Same thing with like suicide. If you committed suicide within your first 2 years, they're not going to pay your death claim. They'll probably send the premiums back, but they're not going to pay the death claim. But after that, if you commit suicide, it's the same as death.
Really? Oh, in all, I heard that if you commit suicide, why do you always hear that the insurance is done, won't pay out on that? Why do you hear that?
Yeah, most cases will after 2 years. But they don't want, someone to go buy life insurance just to go kill themselves.
Yeah,
You know what I'm saying?
Insurance company only change things if they find a material like false representation.
Yes.
Or is it, can they change, and are there any other like loopholes where they can change things?
There's a contract in place, so it's whatever the contract says, right? Okay. MIB stands for Medical Insurance Bureau. They can go in there and find information. It's important to be honest on all your stuff. Okay. Underwriting. Here's another part. So underwriting is the time period after someone buys life insurance, they go into this underwriting period, and there are underwriters that look at your case. They look at your policy, at what you're trying to buy, how much life insurance you're trying to buy, and evaluate the risk. Should we insure this person or not? They can use your application. They can use that MIB report, the Medical Insurance Bureau. They look at your driving record. This guy has 2 DUIs and 5 speeding tickets. He is too high of a risk, right? Among other things. Well, he likes to hang glide every year or whatever. And so like we had one that was a child, I've only had one of these, but a 14-year-old who was a student pilot, right? And the underwriter said, no, we will not insure him unless there's a clause that if he dies while flying, we do not pay out. So if he dies of other natural causes or anything else, any accidents, anything like that, that's fine. But if he dies with flying, anything related, we will not pay out, right? So the family decided to go ahead and move forward with getting him the coverage. They wanted this permanent policy for him with that clause that if he dies while a pilot, then they're not going to get any money. Does that make sense? Yes. But you as an agent, you should do what we call field underwriting. So don't just like take the client's word for it. Like if you see cigarette butts, ask, you know what I'm saying? Like ask about any medication they're on. Like, you know what I'm saying? Like you try to get as much information for the underwriters as possible. And when they tell you, oh yeah, I'm on this high cholesterol medication and I have this and this and this, don't submit it as preferred elite. Like go talk to an underwriter first and then do your own little kind of research and underwriting. But the underwriters are going to determine, one, if they're going to insure him, and if they're going to insure him at like he's healthy, he's unhealthy, there's different rating classes, or sometimes like, well, he has a DUI, it's within this period, we're going to give him a way higher cost to insure him. Does that make sense? Mm-hmm. So that's what underwriting is. Twisting, churning, rebating, these are all like illegal and unethical practices. Twisting means misrepresenting another company or product to make a sale. Like let's say they have a policy and you're like, oh, well, they don't do this and they don't do this. You know what I'm saying? You're kind of like twisting that kind of information about another product basically to sell your product. Churning is when you are replacing something unnecessarily because you're trying to make a sale. Like they already have a universal life and you're trying to replace it with another universal life, or you keep replacing policies. Really, it's not that great to the client. You're just trying to make money. And then rebating is when you think about a rebate. Like you're the producer, the agent is offering money. Like, hey, buy this policy from me, and I'll give you $1,000. Like you're trying to pay your client to write a policy with you.
What if your family just wants to transfer over to you? Is that, can they do that without it looking
anytime you're doing her question was, what if your family just wants you to be the agent and they want you to rewrite it? You still have a responsibility to that client. So you need to look at what they have, and if it's not better, or there's not a significant, or they're having a loss of money to move it, don't do it. You see what I'm saying? Especially it's your family, right? So you have to still do what's right 100% of the time. All right, mortality versus morbidity. So mortality means death. Morbidity is sick. So mortality pertains to life insurance. So mortality tables are what these actuaries are using to determine like the underwriting stuff. Does that make sense? Mm-hmm. So mortality, how likely are you to die? It has to do with life insurance. Morbidity has to do with disability insurance. How likely is this person going to have a disability claim? Become very, very sick, need disability. Does that make sense? Okay, pretty easy once you understand that difference there. Contract of adhesion. So basically, these are contracts. It's as is. Like, you know, if you sell a policy to someone that's Transamerica, they're not going to write a special contract for that person. Does that make sense? It's what everybody's getting. That's what, you know, the FFIUL with Trans. That's what all the people that are getting that FFIUL. We're not going to alter contracts or alter the insurance based on the individual. Okay, riders. Now, riders are very popular. You're going to use them a ton. A rider is something that adds on to the insurance policy. So you have your regular policy. Let's say I have an IUL permanent policy, but for an additional fee, and sometimes there are free riders, don't get me wrong, but usually for an additional fee, think about it's like writing on the back of the policy. Like mama turtle, baby turtles on the back. That's how I pictured it. They're writing on. Okay, so there's little fee usually, and there's additional benefit. So it could be a long-term care rider. Those are very popular right now. A children's benefit rider. So the children's benefit is like, I have a $100,000 policy, but I have a little rider. It's not a separate policy for my child. It's a little rider. If my child dies, I get $10,000 for their whatever funeral. Does that make sense? So it's not a separate policy. It's just it's not even in their name. It's just they're just a little insured. Additional insured rider. That means that there's a second person. So sometimes there'll be one policy and the wife is just an additional rider on the policy versus two separate policies. Accelerated death benefit rider, another very popular one. A lot of the policies that have free ones of this. So like, for example, if you become terminally ill or something, you can, instead of waiting till you're dead, you can accelerate that death benefit while you're alive and use it while you're alive because you're terminally ill or something. Waiver of premium. Let's say I'm get sick, I get disabled, and that waiver of premium rider kicks in. It pays my premiums. It waives the premiums while I'm disabled. And it's just waiver of reductions, kind of the same thing. So these are just riders. You don't have to. I don't think there'll be a ton on these actual riders. Just understand the concept of what a rider is. Okay, there may be a waiver of premium on your test. Okay, conditional receipt versus binder. So when I sell a policy, let's say I sell Hannah a policy, and she gets a $500,000 policy, she pays me, let's say, $500. That's almost like an offer to the insurance company. Then you go into the underwriting period where you're going to do a medical exam, look at your medical history, and the underwriters are going to look at you. But she gave me money. So because she gave me money, we're giving her a conditional receipt. The conditional receipt is kind of binding, where even though they haven't done her medical exam, if let's say, God forbid, she falls in the shower tonight and dies, she could get that death benefit. You see what I'm saying? So on certain conditions, right, certain conditions, because she gave me money, she's covered until the underwriters say she's not covered. Okay, so during underwriting, a conditional receipt can still pay out. So because it's conditional, there's conditions. So you might have a conditional receipt that says, do you have HIV? Have you had cancer in the last 10 years? Like, and so if you check yes to any of those, conditional receipt is void. Make sense? Okay, the binder is different. That's with property and casualty. So that provides immediate coverage. They paid the money, you immediately have coverage, you leave, you get in a car accident, no matter what, you're covered. Make sense?
I'm a little confused on it. Just the conditional receipt. Can you go over that
There's
one more
conditions. So that's having to do with life insurance.
Okay.
Binders, property and casualty. So let's say you buy auto policy. Again, this is not auto insurance. We're just trying to explain to you what conditional means. But binder means, like, if you ever bought insurance and they give you a binder, you put it in your car, because if you leave there, you're covered, right? This is not the same with life insurance. Life insurance, she pays me money. She pays me the $500, but it's conditional. So based on that particular insurance company's rules. So one company could say, does she have HIV? Has she have HIV? Does she have cancer? Does she have heart disease in the last 5 years? Whatever their conditions are. If she answers yes, she's not getting paid out until they're going through underwriting, right? Or it could be, if she dies of such and such, she doesn't pay out. So do you see what I'm saying? So it's not automatically binding with life insurance, although all the carriers we use have great conditional receipts, I would say. Okay. So again, usually they slip and fall that night, even though they haven't gone through underwriting. I haven't even brought the policy back to the office. She had a heart attack. She's cool. Her family gets money. I'll give you one story on this. In our Torrance office with the Mockets, we had a guy who, his brother, he tried to get him insurance, and he was kind of slow and he was kind of lagging, and he finally was like, you know what, you need this, we're going to do this. So he does it. The brother buys the policy, pays the money, the conditional receipt went in place, the money was insufficient funds. Like it didn't even clear the bank account. The first $300 didn't clear. And they're in underwriting. He doesn't do his labs. He's totally flaking on everything. He goes on a ski trip. He dies. Okay. Nationwide still paid out because it still met the conditional receipt requirements.
Wow. Wow.
Yes, we have amazing carriers. So just understand what the term is, that there's conditions, you know, versus it's automatic binding like auto insurance. Errors and omissions, that's, you've heard the term maybe E&O. So once you have your license, you guys will all have to get E&O. By law, as an agent, an insurance agent, you must carry E&O insurance as soon as you pass your exam. So as soon as you pass your exam, when you go through that appointment, remember when I told you appointment, getting appointed with the carriers, you'll have to pay for your E&O. So we have great E&O coverage. Our president is trying to recreate our E&O platform right now where you'll have multiple carriers to choose from and you shop it. But right now, as of now, we've had the same carrier for a long time. I've had it for a long time. It's incredibly lower than anything I've seen out there, but you have to pay your E&O. With us, it's just kind of like you know, as you get paid, that little fee comes out of your paycheck, you know, and then if not, it's part of the access pass fee anyways. All right, agent versus broker. In life insurance, there's no such thing as an insurance broker. You can only be a life insurance agent. An agent represents who? The provider. An agent represents the insurance company. An agent's also called a producer. A broker, like in real estate, represents the client. Different terminology there. Got it? Okay, the insurance commissioner. Okay, so these are elected people, just like a governor. They enforce the insurance code. They cannot change the code. Remember, all types of insurance are regulated by the state of California or the state that you happen to be in. Non-insurance products like securities and stuff are regulated by the federal government, by the SEC, FINRA, those things, those types of rules. But the insurance commissioner can take away your license. He can also give you provisional license. Let's say you had some type of theft when you were a teenager or something. I had that happen where someone got a provisional license. It means you can do the same things, but when you go to get licensed in other states, you know, it becomes a challenge sometimes, right? But he kind of makes those decisions. All right, now we're going to get into the types of insurance. So we have term versus perm. Term is temporary insurance. It's usually less expensive. The costs go up once the term expires. There's no cash value. There's no savings portion of it. It's just straight insurance. It's like renting versus owning a house, right? And eventually the coverage will expire. It's also called pure insurance. By the way, I don't know if Coleman mentioned, the things in the red are things that we've seen a lot on tests, okay?
Why do they call it pure?
Well, think about it. So you have lots of different types of insurance. Riders, bells and whistles, all kinds of stuff you can add to it. The permanent insurance has cash value, where term is just insurance. So when let's talk about what term is. Term is like this. Let's say you have auto insurance, you guys. You have auto insurance. You have to get in a car accident. Something bad has to happen for a payout to happen. Yes?
Yes.
Yes. Okay. So if you don't get in an accident, you are a great driver and you never have any need for it, does that money just go wasted? Yes. Yeah. But why do you have to have it? First of all, it's a law, and second of all, just in case, right? Most people don't have huge cash resources and emergency funds to pay out if someone slams into their car. We were out in Beverly Hills the other night with our kids on my birthday, and we went, there was an ice cream place, and there was this yellow Ferrari. This guy was getting his ice cream cone, sitting in his yellow Ferrari, eating his ice cream cone. My daughter's like, he's living the life, right? But when he was getting his ice cream, this dumb girl backs right into him. He's parked, backs right into him. She comes, she looks around. We're standing across the street. Sean's like, she's gonna freaking drive away right now, right? But there were so many people watching. She got out. She went back to her car. She wrote her name and her phone number and put it on his windshield, trying to look like a good citizen. Sean walked across, waited for the guy to come out with his ice cream cone, and his English wasn't that good, right? But he's like, that girl. He's like, what's this? Oh, ha, ha, ha. She gave me her number. Ha, ha, ha. That happens all the time, right? And so Sean's like, no, fool. She hit your car, right? And so he's like, what? He's like, look at your car. He's like, oh, oh, he hit my car. Like, yeah. He's like, call it, because it could be a wrong number. She looked shady, right? He called, it was a wrong number. But Sean went, he had taken a picture of her license plate and gave it to him, right? So you don't know when things like that could happen to you. So that's why you buy insurance. But if you don't get in that accident, no one backs into you, it was wasted money. Same thing as term insurance, pure insurance. So you're buying insurance, but instead of protecting against the risk of a crash, you're protecting against the risk of a loss of income because the breadwinner is dead. Make sense? So it's temporary, just like auto insurance. There's a stop point, and it's pure insurance. So if you don't die, it was wasted money. So term usually comes in 20 years, 30 years, 10 years, a certain period of time. So again, if I'm NBC and I'm buying it on David Letterman, it could be the 5 years that I have a contract with him. Make sense? It could be 20 years or 30 years, which are more popular type of terms. But if I don't die in that time, that money was all wasted. That's why they call it just pure insurance, because that's all it does. It doesn't do anything fancy, okay? Well, permanent is a little bit, it's more expensive initially. It's more expensive initially. The premiums remain the same, you know, typically always. The cash value builds up inside of it. So if there's a savings portion building inside of it, it's like owning the house versus just renting the house, and the coverage doesn't expire. It's there till you die. So it's there when you need it. Most term policies never pay out. Why? Because you don't die in the next 5 years and 10 years of a major car collision or something. You die of natural causes, of old age. So again, it might not be there when you actually really need it. But again, it's for just in case. So there's two major types. There's whole life and there's universal life. Whole life is like I say it's like the dinosaur. It's been around a long time. And then we don't sell much of it. And then universal, when you see the term universal, it means flexible. That will be on your test. You see flexible, universal. Okay. So, and there's also blended policy. So you could have a permanent with a rider that's a term. So let's say I buy a policy on my life, okay? And it's to build cash value, and it's to have coverage in case I die for my family. But I also am really, really worried about funding my daughter's education. And if I die and my income stops, I can no longer use my income to fund that savings plan for her education. So I may buy a term policy for the next 10 years. So in case something happens, so but it's added to my policy. So I have my $300,000 of permanent coverage, but I have my $40,000, $50,000, $80,000 of rider. But then when she turns 18, I can just pull that rider off. Make sense? Okay. Well, you're understanding these. So term insurance. Term, again, let's say the bottom line is the years that you have it, and the left side is the cost, the premiums. So this is let's say 20-year term. And again, there's no cash value building. You're paying, what does that look like? $30 a month or something, $40 a month. You're paying that for 20 years. The premiums stay the same. This is called level term. Okay, after 20 years, 20-something years, it looks like right there, the policy's done. It ends. Now, because the policy's done, the premiums, if you want to continue this particular policy, your premiums, instead of being $40 a month, will be more like $800-900 a month. Stupid. No one ever renews those policies because it's stupid. It's just ridiculous. Why would you have to renew it? Because you're no longer insurable. Now 20 years later, maybe I have cancer. I can't get insurance anywhere else. I got to pay those premiums.
Can you make that term go for 40 years or 50 years? Or
No,
is it always,
no. You can do 5 years. You can do 10 years. You can do 20 years. You can do 25 years. You can do 30 years. There are some 40-year policies, but not typically. No, the insurance company doesn't, want to do that. They want you to get a permanent policy, pay their higher premiums, right? Okay.
When you say there's no cash value.
There's no cash value. It's just like auto insurance. You pay whatever the cost of. So here's, okay, this will help you understand some concepts. I think all insurance is that type of insurance. Just so you know, that's how I look at all insurance. Insurance goes up every year. Even though the premiums stay the same, insurance costs go up every year. Based on what? Your age. You're more likely to die the older you get. So your cost goes up. Except in the case of the juveniles. Babies, actually newborns, have a higher cost. And then when they hit a certain age, it goes down. Because again, they're more likely to fall into a pool or bump a head or fall off a building or, you know, so they're babies. They're not, but then once they become a certain age, they become less risky, and then the cost goes down. So that's the only other time. But otherwise, for adults and us, our premiums go up every year. Our costs go up every year based on our age. So just, you'll understand this concept in a second. Now, premiums go up. So other types of term are called annual renewable term. So this is where it goes up every year based on age. Does that make sense? So I might, instead of looking like this, where it stays the same for 20 years, I might start off under the 20. I'm paying $18 a month, and then after a couple years, I'm paying $19 a month, and it's like $20 a month, and then it goes up. Instead of at the end of 20 years, still paying $40, instead I'm paying like $80 a month. So based on my age, I start off low and it increases. That's what's called annual renewable term. Level term looks like what I just showed you here. Level term, instead of starting off at $18 and ending up at $80, instead I start off at $40 and stay $40. So what does that mean? Think about this. Level term, if I'm, instead of starting off at $18 and ending up at $80, instead, or whatever it is, instead I start off at $40 and stay at $40 for the entire 20. So what does that mean, guys? That means that you are overpaying in the early years to underpay in the later years. So it's the same thing. It's the same thing. People just like the level because they don't like the thought of things going up, right? But it's the same thing. Okay, so again, you buy level terms, premiums stay the same, face amount stays the same. Then there's something called decreasing term. Not very common. It's not very common anymore. In the Midwest, actually, sometimes it is still, but not in California at all. But it's usually a 30-year term, and what happens is premiums stay the same, but the face amount decreases. So I might start off with the death benefit being $300,000, but over the 30 years, it decreases. So if I die here right away, I get a $300,000 death benefit. If I die here, I might only get $150,000. But now towards the end of the 30 years, I might only get a $10,000 benefit. So the reason that this became popular a while ago was decreasing term became popular for mortgages. So I bought a new house and I have a new big old mortgage payment. I need life insurance because if I die, my family needs to keep this house. But I would buy the decreasing term, because why? Because it was cheaper. It's cheaper, but it decreased over time, over 30 years, to mirror the mortgage. So your test question would be, what would mirror the mortgage? Decreasing term. Okay, mirroring the mortgage, decreasing term. Again, not very popular in California. Okay, whole life. Okay, now we're gonna get into, if you understand this concept, you guys, you're gonna pass so many test questions. But a lot of the life portion of your test is having to do with this. So it's also sometimes called traditional life. It is a form of permanent life insurance. It endows at 100 years old, meaning that's when it ends at 100 years old. It becomes, endowment is when your cash value equals your face amount. Now, I want you guys to understand this. So questions, let me have them. But okay, very limited in your pay options, because if, let's say, now again, it's a permanent policy till age 100, okay? So instead of being $40 a month, like this term policy, for the same amount of coverage, you may have a $100 premium, a higher premium, okay? Why? Because some goes towards paying that face amount, that death benefit, and then the rest goes into cash value. Cash value is a fancy word for savings account, okay? In a whole life, the savings portion is not very good. It maybe earns 4%. Some of them earn 3%. They're a really good one might earn 6%. They all suck, right? Very low earning cash value. But people liked it. Why? Because it was permanent. That's all that existed was term or whole life. So when whole life came out, it was very popular because I'm not going to die in the next 20 years. I might die, when I'm 90, and I want to leave an inheritance to my kids. I want to make sure that I'm always coverage. I always have coverage, that if in 20 years from now I do have cancer, I still want to be able to have insurance. So I buy a permanent policy that will always be there when I need it. Again, there was term and there was whole life, so this was all that existed. So people would put the $100 instead of the $40 for the term into this policy. Some would go to pay the cash for the insurance, and some would go towards the cash value in a crappy savings account that was in the general insurance account of the insurance company. They could do whatever they wanted with your cash value and pay you their 4%. Premiums stay the same all the way to age 100. Let's call your face amount 300 grand. That stays the same all the way to age 100. So if you look at this diagram, This is what I really want you to understand, this concept.
Real quick, do you get money when you turn 100? Do they give you, is that?
Well, I'm going to show you that.
Okay.
Okay. So this cash value was a savings account. People liked that too. But I want you to look at this diagram. And I wish I could actually just draw on it, but I can't. I don't know how. But okay, so maybe my mouse. Where's my mouse? Maybe my mouse will. Can I? Yeah. Okay, good. So see this line? Okay, so this right here, let's say this is your face amount. It's $300,000. Okay, and you're putting in the same premium. Some goes towards the cost of insurance. Some of the premium goes towards the cash value. Okay, over time, you're putting that $100 a month in, $100 a month in, and you're increasing your savings account. Okay, till age 100. Now, oops. Okay, now what I want you to understand is if you died here, let's say you bought this policy and you died here, the life insurance company is going to give you the $300,000 death benefit. But if you died here, they're still going to give you $300,000. The thing is, half of it's going to come from the insurance company and half of it's going to come from your cash value. So they're still going to give you 300, but half of it's your money. You're getting your own money back. Okay, so if you died here, you're still going to get 300,000, but you're just getting your money back. Okay, so now because this is a savings portion, you can take money out of it. So let's say here you had $400,000 in your cash, or sorry, let's say you have $40,000 in your cash value. You have a $300,000 death benefit. You have $40,000 in your cash value. If you want to take that money out, you take out $40,000 on a loan, and they suck, okay? But you take this out, and then you die. Now your death benefit is reduced, so your family now only gets $260,000. Does that make sense? So you can't get both. Now, let me just ask you a question. This is not on your test, just so you can be a crusader. If there was a bank account and you put your savings account in this bank account, and when you died, the bank kept your money, would you do that?
No.
No. Why would you do this stupid thing? It's stupid.
Yeah.
Okay. So there's only one policy that we offer that's whole life that I like. It's not for savings. It's purely a death benefit policy that it's like funeral expenses through Everest and those types of companies that is structured like a whole life, but not for this type of thing. But again, it was the only permanent policies out there. So when you go ahead, question?
Yeah, maybe you're going to answer it. I just want to know if you turn.
Yeah, so endowment is when you turn 100. So remember, it's when your cash value, your savings, because you're putting money in the savings, equals the amount of your face amount. So remember, our face amount was what? The face amount's a death benefit, so 300,000. So my cash value equals 300,000 at when? It's usually around age 100 because it's scheduled to endow at age 100. If you endow early, how could that happen? How could you endow early? That means that this is a great savings portion. It's tax-free. I'm going to put more money into it. So let's say you put extra money into it because you like this savings thing, and now it reaches 300,000 early before age 100. Guess what happens? You cannot get both. So now you've endowed. Premature endowment, okay? Modified endowment is what the test question is. That modified endowment, it's not supposed to endow at age 100. So now, because you can't get both, the policy is surrendered, it's gone, and now you get your 300,000 back like you asked, but guess what happened? The tax shelter's gone. People like this because they're not taxed on that cash value. But guess what? I'm taxed on the entire 300,000 that was taxed deferred growth. That sucks, right? So it's scheduled to endow at age 100. Make sense?
Now, if you get that 100, okay, so if it's not an early, like modification, didn't modify, you didn't go in early and get it, and you turn 100, do you still have the tax?
Typically, yes.
No? You still have to pay
Typically,
taxes?
yes. If it endows, then let's say you live real long. Yeah. So there are some that are structured to go longer because people are living longer, but that's typically how it was always structured to work. Yeah. At age 100, get your money back because you no longer have that.
But then you have to pay the taxes on it.
Stupid,
Yeah.
right? Okay, good. 60, we're building crusaders here too. Okay, so who sells whole life anymore? Only these old companies, these old mutual companies. Yep. They're very easy to replace, by the way. Okay, so you have your universal life insurance. Now there's a place, like I said, there's a place for all these products. Okay, but now universal life came out. So universal means what? We said it already. Nope.
Oh,
Flexible. So what's flexible? Okay, so it matures later. It will illustrate longer, okay? It is still permanent life insurance. It still has cash value, but there's flexibility. Flexibility in the payments. Now let's go back to whole life. When I go back to whole life, there is no flexibility in these payments. So let's say your premiums are $100 a month. You know, you have to pay, you have to pay, you have to pay, you have to pay. If you can't pay your premium in a term policy or a whole life policy, you can't pay. Let's say you lose your job. Now the policy surrenders. It's gone. What happens when the policy surrenders and it's not in force? Taxes, penalties, right? So the nice thing about the universal policy is if I can't pay my premium 1 month or 2 months, or let's say I'm retiring and I don't want to pay my premiums anymore, the money will come from the cash value and move and pay for itself. If there's money in the cash value, it'll pay for itself and keep it alive. Keep your tax benefits in place. Make sense? So nice flexibility. Okay, what it doesn't say here, we might need to add this to the slide, is it's not just flexible payments, it's also flexible face amount. So remember on the whole life, you cannot get both. On here, you can. The face amount can increase. So for example, that cash value starts building. So let me just explain this. So here's your face amount 300. Here's your cash value. When your cash value starts to get to 300, your face will start to increase. So there's always a corridor here. They don't meet, they don't endow. There's always a corridor, we call it the tax corridor right here, that makes it so that you don't have to pay those taxes. So just of the two, if the cash value still sucked and it was still only like a 5% or 4% or 3%, which is better? Which one's better of this and whole life? This one is much better. Duh, right? So even if it doesn't have any bells and whistles and it doesn't have a great savings, it's still better than the whole life in my opinion. Okay, but the whole life, the concept of how this works is, if you understand that, you'll be able to understand so many of the test questions. Okay, so I really want you to understand whole life. So surrender means to give up, right? Just think, I surrender. I have to do that with my kids all the time, right? I give up. When you surrender, it's a full cancellation of the life insurance policy. Oops, what is that now? I don't know what that is. Here, hold on a second. There's something, you guys are probably not seeing it, but we were. Okay, so you're allowed to surrender your policy at any time. The good news is that in the permanent forms of life insurance, they'll build cash value over time as long as they are funded properly. And upon surrender, the policy owner gets access to these cash funds. Problem is, you will be subject to taxation. So remember, it all grew tax deferred in there. So now you have taxes. You also might have surrender fees, penalty fees. So what that means is there's a declining surrender charge, back in sales charge. So in the first, let's say 5, 10, 15 years even, depending on the policy. So if they like cancel in the first year, they could have 10% penalty. They cancel in the 8th year, it's less. And the 10th year, it's like almost 0. And then the 11th year, no surrender. So these are not policies that should be short-term thinking. They should not be used for like an emergency fund. These are all long-term thinking type policies. Make sense? So surrender means to give up. So now let's say you surrender. There's options with your cash value. Okay. So what are the options with my cash? I had 40,000, I had 100,000 cash, and I lost my job, and Hannah and I are not business partners anymore, and we don't want this policy to be in place. I'd rather have my cash at this point. It's my option. It's mine. I'm the owner. I can now surrender. So what are my options with that cash? Well, number one, you can just take it as cash. To take cash, right? So let's say she has, I have 100,000 in there. I can take it out. Again, minus, I'm going to hit with the taxes on it and minus any surrender fees, and I take my cash, right? There's also 2 other options on permanent policy. Now, if you listen to me, just like the Sturpey's thing, this will help you when you take your test. So extended term, I have 100,000. I had of cash or whatever, 40,000 of cash, let's say. I had a $300,000 policy. Remember my face amount was 300,000? What do you think extended term means? It means to take that cash, that 40,000, and extend a term out for as long as that term will go to make my 300,000 face. So I still want my 300,000, and I buy a term policy extended as far as possible. So that could be 3 years, 6 months, and 18 days. I still get my $300,000 of coverage because that's what $40,000 buys me. Make sense?
No, can you just go over
Okay,
one more time? Sorry.
so
Okay.
I could take, so my options with my 40,000 is take it in cash, I have $40,000 cash minus my fees, minus
This
my,
is when it ends? Or
if I
just-
surrender, if I
Okay,
give
you
up,
surrender.
I
Okay.
surrender my policy.
Okay.
Because like I said, I bought that 300,000 when we were business partners. But we're not business partners anymore. I don't need the insurance on her. Plus I need the cash for some reason. Or I just can't afford my policy. For whatever reason, I don't want the policy anymore. I surrender. Question.
So basically that means that you're changing, you say, I don't want this, I want to surrender the whole life, turn it into term with
Well-
the cash and no taxes.
It depends. You could still have some issues there.
Wow.
Okay. So, but their options are. So let's say I can't afford the policy anymore. I can't afford my $500 a month premium anymore, but I still really desperately want the coverage. Okay. Because this is all my husband and wife now, right? We lost our job. I still need the coverage. So instead of giving me the dump, money, I need the coverage. So instead of taking cash, I take the option of extended term. So with that 40,000, I will get a term policy for the same face. I'm just extending the term out for as long as it will last.
And are you still paying into or are you using that
Nope.
40,000?
I'm just using the 40,000 to
That's it.
buy a term
Got it.
policy because I still
Okay.
want my coverage. Okay, so now it'll make sense when I tell you what reduced paid up is. What do you think that means? Think of reduced. Okay, so now let's say I had, I still need the coverage for a certain amount of time, but I can't make my premiums. So instead of getting a term policy for the 300,000 for 6 months, 8 days, whatever, right? So instead, I'm getting a reduced face amount, but paid up for the time period I needed. So I still have my, let's say this has 200,000, but let's say I sell my 300,000, but the new term might only be, $2,500 face amount. So instead of the 300,000, I have a $28,000 face amount. Whatever the 40,000 will buy me for the amount of time I want. So you see what I'm saying? So just think of lower face amount is reduced, paid up. The same face amount, just extending the term out, is extended term.
And you
guys
don't
got it?
have to pay, you can use
You just
the
buy
money
it.
already in there.
You're just taking the cash and you're doing something different with it versus taking the cash.
And so let's say if something happens, right? And you're not at your term, whatever, something happens, you still get paid out?
So so now let's say I picked the extended term,
Yeah,
right?
Yeah.
And the 40,000 only bought me 18 months. Okay. If I die in that 18 months, I'm going to get my 300,000. If I die after the period, I get zero, just like a regular term. It reduced paid up. If I die, now that I've taken that option, I don't get my 300,000. I get whatever that bought me for that same period. So maybe 2,500 or something.
So let's say you're extending for 18 months, whatever it may be.
That would be extended term.
Okay, the extended term. Can you then from there start to pay?
No.
No, that's it. You're done.
Yeah, you're just
Okay.
buying a term policy. Okay. All right, so 1035 exchange. Now 1035 exchange has to do with permanent policies, not term policies. Okay, all the stuff we're talking about is permanent. There would be no surrender options on a term policy because why? There's no cash value. Okay, so 1035 has to do with permanent policy and the cash value. So now I'm not necessarily surrendering. I'm not giving up my policy. I want a different one. I've had this whole life and it sucks and it's not earning anything. And then someone shows me a indexed universal life with Transamerica and it has long-term care, all these bells and whistles. I want that, right? If I cancel my policy because I want a new one, guess what happens to my cash? It's a surrender option now. I'm going to have taxes. But the 1035 transfers my cash to the new policy, and it's not a taxable event. So now I take, as long as it's like for like, so as long as it's permanent to permanent, whole life to universal, universal to index universal, as long as it's like for like, the money, let's say I have 40,000 cash in my whole life, I move it over here, boom. This still could occur surrender fees, but it's not going to, because let's say this policy with, New York Life has this big old surrender fees or something, they can still charge me that. But if you know what, if I feel my benefits over here are better, I can still make that decision. I try not to do anything that's going to incur my client a surrender. Okay, but basically those things happen, but no taxes will happen. So it goes like for like. 1035 is the paperwork that makes it so it's not a taxable event. Make sense?
Same with real estate.
Yeah. Yep. The same thing with real estate. You buy a new house, it moves the liability over to the new property. Got it? Questions? Good. All right. Russ, you want to do this page real quick?
Sure, Jamie, absolutely.
No, I'm back on, Jamie. I'm back on.
Oh, you are?
I'm
Okay,
good.
go ahead, Coleman. I didn't know if you were there. Go ahead,
Sorry,
Coleman.
Russ. Yeah.
All good.
No. So we're good. That was awesome. And guys, I'm telling you this right now. We have got to drive our licensed field force through the roof. We need more people that are out there. I don't know about you, but I feel like the education that we wind up giving as a result of this is so valuable that when I study this plus the other exams that we've had to do, I mean, it literally gave me like the PhD in personal financial planning that you're not going to get anywhere else. So just the fact that you're getting a chance to have, you know, a little bit of self-improvement and understand these concepts is across the boards an incredible opportunity. So don't take it lightly, the education that we're getting. So I'm going to go through and I'm going to talk a little bit about the, the compensation. I'm going to share my screen again and kind of talk to you a little bit about this. And so hopefully you guys can see this. Russ, can you give me a thumbs up? Does it look good? Give me.
Yeah, you're good.
Yeah,
You're
okay, good. And then I'm gonna, once I'm done with this piece, Russ, I'm gonna turn it back over to you for the next section. Is that cool? Okay, good. So here we go. So life insurance is one of the highest paid industries in the world. Okay. And the reason being, I'm going to give you the concept of why this is the case. Because when you go into a life insurance contract, it's a contract that's 10, 15, 20 year. I mean, we're talking about the relationship that's expected of the agent is over a lifetime. But one of the wonderful things about how we're compensated is that we're paid all of that money that we're expected to be able to, you know, manage that relationship is all compressed into the first year. So just because we make, you know, 10 or 20 or $30,000 on a single deal is not something that you just go, oh, well, I just made a ton of money. That money is designed to be able to make you profitable so that you can continue to service clients and service those clients well. You know, if you look at that, in my opinion, we have to bring thousands of dollars of value to the relationship. This means good follow-up. This means, you know, reaching out to your clients, making sure that they understand, doing annual, you know, reviews and strategy meetings. That was one of the things that you know, I learned recently is you don't do reviews with people, you do wealth strategy meetings with them. So now that you're in this position to be able to do this is that, you know, I wanted to show you some of the potential compensation. So a client saving $250 a month, and by the way, you'll get access, once you get your license, one of the things that you're going to get is you're going to get access to the software. You're going to be able to run illustrations. You're going to be able to design plans for yourself and your family, you know, so that you can go to, like, every time that I design a plan, I go, oh my gosh, I got to get this done. Then I bring all the contracts to Jamie. Jamie is my agent, right? She's the one that does everything for me, but I'm still the one that's going to design it because she taught me very well how to design my own stuff. But you can go in and do the software and all that kind of thing to be able to get that done. But at $250 a month, right, they're going to wind up on average at what they call annualizing the premium. And again, this is a rule of thumb. And I want you to have some context of how valuable this license is then you're going to wind up, they're going to pay out a $3,000. At Trans, they have a little bump up in the contract there, which is they're going to multiply that by 1.25%. So you're going to wind up getting $3,750 of target premium, or what we call points. Now, again, go over this with your senior marketing directors, go over this with your field trainers, because they're going to be the ones that show you in the illustration software how these things work. But as a training associate, so the second that you get your license and you go do a deal that's $250 a month and the target premium is exactly what I show, you're going to make $937. Now, think about that. You're going to make $937, and it's going to be roughly, even if you're not very good at this, it's going to be maybe about 4 hours of work. That breaks down to about $250 an hour. I don't know if that's more than what you're making at your job, then this is good. If that's less than you're making at your job, then you have to take a look at some of these other, compensation levels here and kick some butt. So as an associate, so the same customer, you're going to wind up helping them to save $250 a month. You're going to make about $1,312, right? As a senior associate, you get a bump in contract. So on the same customer, you sit down, and so you're doing the same work with the same exact customer. Your contract goes up to 45%. So you're going to make $1,687 on one customer. Okay. And then as a senior marketing director, you're going to get a 65% contract. which is going to make you $2,437. So I'm going to tell you, wouldn't you want to be at a senior marketing director contract? This is why I was so furiously crazy about building my team, because I knew that if I had a big team, hitting senior marketing director would be a snap, right? I would just be able to get it done quickly. But if I had a little team, I was going to have to run around and I was going to be trying to like sell stuff and do all that kind of thing. So I'm going to tell you this right now. This is why you want to build a big team, so that it's very, very easy for you to get to senior marketing director, so that every time that you get another customer, you're going to wind up making a lot more money. So again, the question is, and this is a rhetorical and, you know, mildly stupid question, for the same work, would you rather make $937 or $2,437? Again, rhetorical question. It's stupid, because I know that you'd want to make $2,437. Okay. So anyways, across the boards, there you go. Okay. So I'm just going to go through. So, last couple of slides that I'm going to walk through to kind of just handle that is that one benefit to the whole life universal life policies is the ability to have cash value. I know Jamie talked a little bit about this at the end there, but the cash value can grow tax-free for the client. Okay, so it can grow. There's no taxes. You have insurance money that you put into your insurance policy. You're never going to get a 1099. You wind up taking a policy loan. You're never going to have them report that to the IRS. It is literally one of the most wonderful, places that you can put that has tax advantages that's out there. Okay, so there is a limit to how much money you can put inside the cash value of a policy. Okay, so if you put too much money inside your policy, what will happen is you will what's called MEC the policy, or convert it to a modified endowment contract. So what does that mean? So let's break down the words. Okay, modified means to change, endowment means to give, and a contract is an agreement. So when you have a modified endowment agreement or contract, what that means is that now you've changed the agreement somehow. Okay, and so what happens is it actually takes away all of your tax benefits of the insurance policy. So if you could imagine that you're under an umbrella, and everything, all the money that you put underneath the umbrella, as long as it's underneath that umbrella, the IRS can't see it. They can't, there's no reporting, there's nothing that happens. But let's say that one little penny, just a penny, goes outside of that umbrella, then all of a sudden it's like, boom, the IRS can see it and then they come after you. I don't know if you saw that movie, A Quiet Place. As soon as they made a noise, those monsters were chasing them down. That's basically what happens if you wind up putting up too much money inside your insurance policy, is that the IRS goes, hey, wait a second, there's that money, we can go grab it. So you don't want to do that, okay? So those modified endowment contracts, now why would someone want to do that? There is one reason, because they're going to wind up, giving a death benefit, so they don't really care about the tax ramifications. But I'm going to tell you, you're not going to run into many of those where someone's going to want to create a modified endowment contract. Okay, so anyway, so that is one thing. And oh, by the way, so what can you do if you go, well, I'm putting in too much money? So I'll give you the example. When I got started, my policy was I could put about $250 a month, and so that's $3,000 a year. I could put in up to $14,000 a year. Okay, so that was my range, $3,000 to $14,000. I was 29 years old, and it was a $500,000 policy. So what happened is I could put any amount in there between $3,000 to $14,000. So it was $250 a month to $1,200 a month is what my range was. If I wound up putting more than $14,000, which would have been like $14,000 and one penny, then all of a sudden everything that I put in there is now exposed to taxes. Okay, so what do? If you want to put more money in, there's two things you can do. You either raise your amount of insurance, so I'd go from $500,000 to $750,000, or what I did wind up doing is I said, Jamie, I need to put some more money in. So then I wound up going in and getting another policy. So every time that my wife and I, start putting in too much money, we just go, okay, let's get another policy so that we can add more money and create more. So there's no limit to the number of policies that you can get, unless you wind up having it be the insurable need, which we talked about earlier, on the lesson. So this is one of those concepts that you're going to kind of see on there. So don't make this too complicated. It's probably going to be 1 or 2 questions at the most.
It's not really going to be a ton on there, but it's just people are asking, what determines it. It's really you, your face amount, your age. So every policy is different, and when you run illustrations, you can structure it. But you'll know. As long as you don't go over that limit, you're fine.
Yeah, you're totally fine. Yeah, exactly. Thanks, Chief. That's awesome. So buy-sell agreements used by business owners. So this is also sometimes called a cross-purchase plan. So what does this mean? This policy is used to buy your partner's shares, in the business in the event that someone passes away. So let's talk about that. So you have Bob and, you have Sam, and they own a plumbing company, right? So then what happens is then one of them passes away, right? So let's say that there's Bob and Sam, and then Bob passes away. So then what happens is now who gets the remaining share of the partnership? Okay, Bob's spouse. Okay, so Bob's spouse comes along and says, oh my gosh, now I own 50% of this company, and I don't know anything about plumbing, and so then the spouse comes in and is telling Sam, this is how we got to run stuff. I'm a 50% owner. You got to do this the way that I want to do it, and so now there's a huge amount of contention. So what a buy-sell agreement does is Bob and Sam buy an insurance policy that's owned by the company that basically pays a death benefit to the company. And if one of them passes away, then in the agreement, the ownership, their 50% ownership, goes to the remaining partner in exchange for the death benefit of the insurance policy. It's funny, Russ and I literally were in the middle of doing one of these buy-sell agreements and key man policies, and then someone passed away, and it totally messed up the whole company because they didn't have the right insurances, and we were literally just doing the design, and it happened just that quick. So think about that for a second. Someone who has no experience comes in and starts trying to run the company. This is very, very bad. You want to pay them off and keep that company with those people. By the way, these products, if you understand how they work, this is why you want to talk to business owners, because I'm going to tell you this right now. Most business owners that have partners do not have these plans in place, and you can make a lot of money by going out there and seeing these business owners, helping them and building, and going in, helping all their employees, getting their 401k plans. It's awesome. So, Chief, are you going to say something else?
On the test, so you're going to see very little again, but it will be like business insurance.
Yes.
And typically the only business insurance, because otherwise it's individual insurance, right? And right. So the business insurance would be either this buy-sell agreement or the other one that he's probably going to talk about, which is the key man. And so there's not a whole lot, and it's remember, it's multiple choice, but remember business, these types of things.
Exactly. And if it says something like cross purchase plan is what type, personal, group plan, business insurance is going to be business insurance. Okay. So that's awesome.
Insurance, group, individual, right?
Yes. Okay, so key man is the next thing. So this is another policy used by business owners, sometimes called key person insurance. And insurance is purchased for a key employee of a company. This person can be the top salesperson or the CEO or any important employee of the company. Key man insurance is not tax deductible for the business owner, right? Or for the business. So that's the only time, it is like insurance policies, because they get the tax benefit on the back end. There's no tax, you can't deduct it on the front end. So I'm just, just so you understand, if they ask a question, is this insurance tax deductible to the business? Yes, no, maybe so, all the above, none of the above.
A lot of us thought it was for a while.
Yes, it's
not.
not.
A lot of us didn't know that.
And by the way,
it not be on the test. We never knew that. But remember the example I used, David Letterman.
Yeah.
Right. It's a key person that brings in a lot of revenue, and you want to replace that or replace him if something were to happen.
Yes, exactly. So you want to make sure, like, the top salesperson, the top, like engineer, product designer, CEO, C-level, employees. In fact, if you go into a company and you get all of their C-level employees, you could make a significant amount of money going in and doing key man insurance policies, which is awesome. Okay.
John Shen has a key person policy on me. So if anything happens to me, you guys.
So then he could pay out what you would have made him?
I think it's $1 million. If I die, I got a long time ago. If I die, John gets $1 million.
Exactly. But John makes way more than that on Jamie anyway. And so it's really just to kind of like take the edge off. He'll probably go on a little vacation or something like that if that happened, but that's not going to happen, right? So anyway, so group life insurance. Group life insurance refers to plans offered by employers. Whoops, sorry about that. Most group life insurance policies are term because they are cheap. Businesses, generally speaking, do not want to provide a lot of benefits, especially in today's day and age. However, if they do a group life insurance policy, it's usually a term insurance policy. If an employee has a policy through their employer, but they leave the company, they have 31 days. This is another thing that is sometimes on the exam. 31 days is the amount of time that it takes to convert their group policy, their group life insurance, to an individual policy. 31 days, okay? So remember that is the conversion time. Employer gets the master policy and employees receive a certificate of insurance. So they might give you something that's like, what do the employees receive? The master policy, a conditional receipt, whatever, business continuation, blah, blah, or certificate of insurance. Certificate of insurance. Employers get the master policy, employees receive a certificate, okay?
So employees won't get, like when you buy life insurance and you get a policy that you get to take home that has your name on it, you don't get anything like that. You don't get
Nope.
a policy. You just get this little piece of paper that
Yeah,
says
it's
you
a
have.
little, yeah, it's like usually in your benefits
Probably
package.
what I'm talking about.
Yeah, for sure. And then next thing, okay, so this is really important too, okay? And it's really important because it's important for a couple of different reasons, okay? But when purchasing life insurance, just like buying clothes at Macy's, you can return it, okay? For seniors, right? For seniors, they have 30 days to return their life insurance policy for a full refund. Now, you got to remember the definition of a senior in life insurance is 60 years old or older. 60 years. In annuities, right, which is what we're going to cover then, annuities, it's 65, okay? So it is literally the definition for senior is different in life insurance and annuities. So you just have to remember that. 60 is life insurance, 65 is annuities. Okay, so non-seniors have 10 days to return their policy for a full refund, and seniors have 30 days. So you just have to kind of memorize those. So two types of companies. Number one is called a stock company. So these are non-participating companies. So you might see it as termed that. They must own their stock to get dividends or profits, and dividends are taxable. Okay, so if you own stock, like let's say you own stock in Prudential, but you don't own one of their policies, you can get dividends as a stockholder. But mutual companies, these are also known as participating, they pay dividends. And the dividends of a mutual company are not taxable. Now, why is that? Because the dividends are just basically a return of overpayment of premium. So if you wind up, like if you ever got your car insurance and then all of a sudden you get a little, rebate back in the mail, they said they're not giving you a profit that you have to pay tax on. They're just saying, hey, you overpaid, so we're just going to give you some of your money back. That's what a mutual company is, because you have to own one of their policies. So if you wind up getting some money back from your mutual insurance company, then all they're doing is just giving you your money back that you overpaid. Okay, so that's why the dividends are not taxable from mutual companies, and they are taxable from stock companies. So, for example, if you go to Macy's and buy a sweater for $50 and you get home and you see there's a clearance tag that says 25, you can go back to Macy's and they refund the difference because you overpaid. Would you pay taxes on this? Of course not, because you just overpaid. So it's the same exact thing, okay? So mutual companies is, these are some of the mutual companies. A really good clue to knowing if a company is mutual or not is it says mutual in their name, like Mass Mutual or Mutual of Omaha. That's usually a pretty good clue that that's a mutual, company. So dividends are not guaranteed, and they're issued by and determined by the board of directors. Okay, so State Farm, Nationwide are also mutual companies. Stock company.
So when they say like, oh, my company paid me dividends, I made all this money, you're like, no fool, they overcharged you throughout the year. So just understand, it's just like, they overcharged you and they have to give that back to you. That's all.
That is correct.
It's a refund that they charged you too much.
Yes, exactly. That's perfect. Okay, so stock companies, right? To get part of their profits and dividends, you must own their stock. So some of these companies here are publicly traded or owned by publicly traded companies. So Aegon, Hartford, Voya, Prudential, MetLife, right? The process in which a mutual company becomes a stock company is called demutualization. Okay, so this happened. So I think it was Nationwide. Nationwide decided that they wanted to become a stock company, so then they became demutualized, and then they remutualized and went back to being privately owned. So they bought back all the shares and then went back to being a participating company. So I'm just telling you, it's just one of those things. So if you see demutualization, that's the process in which a mutual company becomes a stock company. It means they're like going public. Okay. So anyways, so that's that. Okay, down to the last couple slides. Okay, so next one here is the types of insurance companies. So you're going to see this too. Number one is called domestic. So this is registered inside. If your state is the state of California, then it's domestic. Then if it's outside of the state of California, it's foreign. And if it's outside the United States,
if it's yours, if you're not in California, because there's some people obviously out of California.
Exactly.
It's registered in your state versus
correct.
outside of the state.
Exactly. So like Pacific Life of Mission Viejo, California, for Californians, that's domestic. But for people in New York, that is a foreign company, whereas Nationwide of Ohio to Californians is a foreign company. But Lloyd's of London is registered outside of the United States, and that's an alien company, right? And so that, just understand that whatever state that you're in, it's domestic if it's in the state, foreign out of state, and alien is out of country, okay? So exam tips. And then I'm going to turn it over to Russ here in just 1 second. So exam tips, read the questions carefully. If on the exam they're talking about a retirement plan, they are referring to an annuity, not a life insurance policy. So whenever you see that term, retirement plan, it's an annuity. Here's another thing. Do not miss classroom or field trainings due to studying for your license. Learning our system is much more profitable long-term than a life insurance license alone. It drives me crazy when people say, oh, I can't come to the meeting tonight because I'm studying for my test. What that shows me is a tremendous lack of discipline. You have bad time management. Figure it out. You can do both. So just make it go right to get in, because the training that you're going to get is how to run an organization. It's how to make a multi-million-dollar business. Getting a license is just one little piece. Running a profitable business is something that is an ongoing training for the rest of your life. You better build the discipline now so that you're not lazy in your approach in the future. Chief, what were you going to say?
I would not schedule your test. If you take your test at a state building, usually it's like 8 a.m. or 1 p.m. They don't have like a lot of options. If you take it at a different place, you pay a little bit of premium to do a local place, then they have a little bit more options. But don't schedule your test the day, like 8 a.m. the night after a BPM, right? Because you're going to be you're going to want to study, and you're going to be stressed out, and you're going to be up late. So I would do it, not the day after a BPM, but he's right. Like, you don't want to miss a BPM to go because I'm home studying, because what does that do? That sends a message to your team that you're not a builder, that you're a producer, that you are probably not someone to follow, right? That studying for an exam is more important than building a team and being an entrepreneur and being a good example. So I studied, honestly, late at night when I couldn't be in the field. So I'd be in the field as much as possible, trying to do as many appointments as possible. And then when I couldn't be on the phone or in the field, like 9 o'clock at night, that's when I got on the computer and I just crammed this crap in and, did as much as I could. Remember, he's saying some tests, tips here. When it says retirement, they will try to trick you. They'll try to say like IRA or something, but this is not a securities exam. So it wouldn't say that. It would say annuity, right? So, so just like what he said about the orange juice, the reason I told everybody that, because they would stay up late all night long drinking coffee, and that dehydrates you and it makes you less focused during your test the next day. So instead of drinking coffee, drink the orange juice. That helps you retain. Eat healthy snacks like nuts and those types of things. while you're studying, and just make yourself do it. It's not exciting, it's not fun, but you want to get that license so that you can move into more important, more fun things, you know. So, and then you want to wrap that up, Coleman?
Yep. And then one other thing that I'm going to tell you too, and this is what Jamie told me. She said, when you're there, you're sitting around afterwards and everybody is coming out. Some of these guys are insurance agents and they're not attached to a firm. Prospect the heck out of everyone in the waiting room. I'm telling you, we've had a ton of agents come into our business because of the fact people go, hey, like I did this. She told me prospect people. I picked up like 3 numbers while I was waiting for them to give me the test, right? My test results. And so I'm going to tell you this right now. You can talk to people. Hey, you know, what firm are you at? Oh, you should come in. Oh, our company is awesome. You know, I want to introduce you to Jamie Villalobos. She's amazing. We're having, you know, a recruitment, event at our office. We're going to show you how to really take this license and get trained. It's awesome. You could literally in one, go take your test, pick up 2 or 3 or 4 licensed guys on your team just like that, right? So very, very cool. So then the other thing too is don't get discouraged if the exam is hard for you. Cash failed like 5 times or something stupid, and when you get this exam, now he's making $1 million a year. Do you think that he's thinking about, oh, I failed my exam? No. Sometimes people say, oh my gosh, it's a message from God that I'm not supposed to do that. It's a message from God that you need to study more is what you need to do. That's exactly what it is. Our great friend June De La Cruz, he had someone say, oh my gosh, they changed the exam and they made it harder. So there's stupid knucklehead leaders in his office saying, oh, the exam's too hard. Then he surveyed every single person that failed the exam and said, how much did you study? How much did you study? How much did you study? And did you know that every single person that failed the exam studied less than like 2 hours, like for the whole time? They just thought they would wing it. Look, guys, winging it in life is not going to get you results. So don't do that. Be prepared. So next thing, if you haven't worked with, your trainer to book your test, book your exam. Book it right now. Like go on there, jump onto the website. If it's PSI exams, I think that that's for more than just California, but you can go in there and book yourself the exam. Why? Because you also need a deadline. Complete all your practice quizzes online, get at least 90% or higher on practice exams to pass, and then read all the cliff notes. So multiple providers, whatever provider you're using in your office, they all have like a cliff notes version of the training. So read those cliff notes. What we're doing today is just going to give you some good foundational stuff to be able to understand this stuff. But your job is to go in there and really start to internalize some of these things. So to get these slides, I'm going to give these to all the other SMDs in the office. For me, if you send an email to baseshop@mcoleman.com, and in there, all you put, sorry, that's the wrong thing. I'm going to tell you what you're supposed to put in the subject line. So listen to me closely because I want you to get this one. Don't send it to that one. Send it to Revolution Licensing. Put that in the subject line, Revolution Licensing, and you're going to get these slides will be sent over to you, okay? So you can study them and make sure you understand it. So with that being said, we're going to go on to the next step here. Jamie, did you need anything else?
No, I just want to say, do you guys need a little bathroom break or something?
Yeah.
Okay, so real quick, before you guys all get up, the next section is the health portion. So it's a little bit more technical, right? So you probably want to take some notes. And then we'll go on to the section 3, which is a short section on annuities. Does that make sense? So we'll take like a little 5-minute bathroom break, and then we'll come back and Russ will do the section 2.
This part's important.
Absolutely. And I'll introduce you, Russ.
Yes, Hannah just said this part's really important. The health part's really important because this is where a lot of people complain that it was the hardest part of the test. So you want to make sure you take a lot of notes in the next section.
Is it the same test anywhere?
So I'm telling you the next part that you guys are going to get is well, I'll tell you, I think that Russ just drew the short straw. So I'm just kidding. But he is an incredible teacher of this business. And one of the things that I had talked about earlier was that in order to be a complete builder, we have to take full responsibility for our business. And that's one of the things that, you know, I have appreciated about Russ over the years, is that he and I have like literally split time on teaching these things. And I know that there are people in my organization, there are actually significant, you know, earners within my organization, that if it wasn't for Russ and his ability to teach and convey concepts, we would be at a much worse position that we are. I also know that I would not be, you know, anywhere near $1 million of income if it wasn't for Russ. He's such an incredible flag carrier. He's literally, you know, my right-hand guy. Like everything that we're doing within our organization, you know, Russ and I are in lockstep of being able to build. I actually feel like since he's moved to Pasadena, we don't get a chance to see each other as much as we probably want to. But I'm excited that I have a chance and opportunity to share a little bit of the virtual screen time with him in this training. But you know, get on the edge of your seats, make sure that you take notes, finish this thing strong. So he's going to cover the next little section here, and then I'm going to come back in to be able to close it out. But let's give you know, our mental round of applause to the great builder, Mr. Russ Coburn. So Russ, turning it over to you.
Thank you, Michael. I appreciate that introduction. And yeah, we're excited to get you across that finish line to $1 million for sure in the next couple of, actually probably just the next few cycles here. So we're definitely excited about that. I want to give you guys one additional tip in terms of taking the test before I get into the slides. And this is something that is critical. And I have seen people literally come in, you know, having failed the test by one question, and then I ask them this question, and it's completely a game changer, which is when you reach the end of the exam, you are going to have the option to go back and change answers. Do not change your answers. You will literally, there's a reason you thought it was the right answer in the first place. Do not second guess yourself. You know, there also gives you the option to go, you know, flag questions without answering them. That's not what I'm talking about. If you have answered a question C, leave that answer C, because I promise you, you will thank me for that afterwards. Hopefully my voice will be in your head when you're at that point where it says, do you want to review your answers? Say no, just submit the test. Just, you know, from personal experience, I highly encourage you to not go back and change your answers. All right, so we're going to talk about health insurance now for a little bit here. I'm going to share my screen with you guys so we can go through the slides. Now, one thing I want to make sure that you all understand is we are, most of our business is not health insurance. The reason we're covering this in such detail today is a couple of things. Number one, because it's going to be, and you know, Jamie said, Hannah mentioned this, it's going to be a significant part of the exam when you actually get to that point. There's going to be a lot of questions about health insurance on it. Another reason is there are definite products that we use all the time for which the health insurance license is required. Now, I'm speaking mainly to California here. I want to make sure that those of you that are outside of California, I know we've got some folks from New York, I know we have some people in Texas, other places that are watching this webinar. There are, most of what we're going to cover applies to all 50 states. There are a few things that are on this course recognized as California state specific, but they're not so dramatically different in other states. But most of the information that we're going to cover here does apply to all 50 states. Excuse me. So I just want to make sure that you understand that. And we're going to get into a little bit why. First of all, the information you need to pass the test, you know, as either Jamie or Michael mentioned, I forget who said it, the things in red are things that are very likely specifically going to be on the exam. But also just from a general concept perspective, you know, obviously health insurance, the term, and we'll get into what it means specifically for exam purposes. You know, health insurance is what covers you when you get sick. It's what allows you to go see the doctor, all that kind of stuff. And most of us will never be in the individual health insurance business. That's not necessarily, that's not why we got into WFG, and it's not why we're part of RFM, and it's not why we do what we do, and it's not going to be the focus of our business. But I'll give you an example of something that just occurred literally 2 days ago. I went in to set up a 401k for an employer. They've got about, excuse me, 65 employees. 65 employees across 5 medical clinics throughout Southern California. And one of the things they asked me is, do you guys also offer health insurance? So it gives you another way to generate a residual income for yourself through group health insurance. We can do the individual stuff as well. It's not really, there's not a, anyway, our goal is to do whatever benefits our clients the most, but if you have that license, you have that ability, you can also share these things so much with, use the license for everything it can be used for. So let's get into this a little bit. There are many different types of health insurance plans. You've got medical expense plans, excuse me, you've got Medi-Cal, you've got—
Hey, Russ?
Yeah.
Sorry, can you stop sharing your screen really quick and then reshare it? It's just,
Sure.
There you go. I think there was like a glitch on your end. You're good now.
We good? Can you see it now?
Yes.
Okay, good. So in case anybody's worried, this is the first slide that actually has any content on it. So there was nothing prior to this that you missed. So different types of health insurance plans. You've got you've got medical expense plans. You've got Medi-Cal, and we're going to get into what all of these things mean very shortly. You've got Medicare. You've got accidental death and dismemberment. That sounds pretty scary. You've got long-term care insurance, disability income insurance, and workers' compensation insurance. So let's start with the medical expense plans, which is probably what you will be the most familiar with by a different name. So health insurance, another way of putting it, is medical expense plans. There are two types, two most common types. One is called a PPO, which is a preferred provider organization. The other one is an HMO, which is a health maintenance organization. Different companies that offer both of these. You've got Aetna, you've got Anthem Blue Cross, you've got Kaiser, Blue Cross of California. You might also have heard of HealthNet. Out here we've got LA Care. These are just different companies that offer these different types of health insurance plans. And then within the medical expense plan category, you've got group insurance, which I was just mentioning. That's insurance that's offered through your employer, and you have many people covered under the same plan. How many people do you need to have a group? You need 2. I think I may have just jumped the gun on a later slide, but nevertheless, a group qualifies as 2 or more. And with group insurance, you notice that's in red, there may be a waiting period. What that refers to is the time that the employees have to wait before they can enroll in the company's health insurance plans. I've seen most common ones are 90 days. I've seen 6 months. I've seen some companies that it's even as much as a year, although I don't think that they can do that anymore. But that's just a time. It's kind of like typically it'll parallel the probationary period for employers. So that's group insurance. Then individual insurance is purchased directly from an insurance agent. And that would either cover you as an individual, or it could cover the entire family. So that's the types of medical expense plans. You've got group and you've got individual. All right, let's talk about an HMO. HMO stands for Health Maintenance Organization. This focuses on preventative medicine through physical exams, doctor visits, hospital visits. If you ever notice, it encourages the majority of what they pay for is things that are paid for prior to the fact. For instance, your annual physical under any HMO is absolutely free. You don't pay for your annual physical, and that's your once a year. It's because they want to, basically the whole goal is to keep you healthy. Why? Because it costs them less. We can say it's altruistic. Oh, they're concerned about me. No, the whole point is that it costs them less out of pocket. They're looking to keep their margins in good shape. So an HMO is going to focus on preventing you from getting sick. They provide both healthcare services and healthcare coverage to their subscribers under one umbrella. So okay, do you guys see the HMO slide on the screen? Can someone come off mute? Neil, tell me what you see.
I can see it right now.
You see HMO?
Yes.
Okay, good. Okay, cool. Thank you. All right. So basically, it gives you the different services, the medical services, the doctors, that sort of thing, and the actual, excuse me, the overall coverage under one umbrella. And it operates through a gatekeeper system. The gatekeeper for any HMO is your primary care physician. So, for instance, my primary care person, her name is Dr. Hannah. I see her, every so often when I need to get some things taken care of. And if she's going to refer me to a specialist, she has to make the referral to the specialist. I can't just go directly to see that specialist on my own. Like I had to see an orthopedist recently. I had to go via my primary care, also known as the gatekeeper. And then, by the way, if it's an emergency, if you need to go to an urgent care, or you need to go to, the emergency room for any reason, that is not something that requires you to go through your primary care first. You know, obviously, if it's 3 o'clock in the morning on a Sunday night, your primary care is not open, and then the emergency room will see you and treat you without you having seen your primary care physician. But under just normal day-to-day circumstances, you got something you want to get checked out, that sort of thing, then you do need to go through, excuse me, the primary care. PPO is a preferred provider organization. Unlike an HMO, you don't even have to have a primary care physician or a gatekeeper. You can choose to see any doctor that accepts that particular PPO insurance. So call them ahead of time. Let's say it's a I don't know, a dietitian or a nutritionist or a chiropractor or something like that you want to see, or even whatever, ear, nose, and throat specialist. As long as they accept that PPO, then you can go see them. So that's the main difference between a PPO and an HMO. Is with the PPO, you do not need the gatekeeper. With the HMO, you have to go see the primary care every time you go see a specialist. All right, a CDHP, or a consumer-driven health plan. This is a PPO plan that is linked to a savings account called an HSA, or a health savings account. HSA is, excuse me, just like a savings account in a bank. It earns interest, not much, just like a bank, but it does earn interest. The PPO plan typically has a very, very high deductible, which will in turn make that CDHP very cheap. So in other words, the premium is lower because the deductible is higher. That's kind of a rule of all health insurance. The more you pay up front, the less you pay on the back end, and the same is true in reverse. So like if you have a plan that has, don't quote me on these numbers, but let's say you have a plan that's a $500 a month premium, and it's got a $10,000 deductible, versus a plan that has a $1,000 a month premium, and it's only got a $4,000 or $2,000 a month, $2,000 deductible. And so that's kind of an explanation of that. And if the client needs to use their plan, they can use the HSA savings account to pay for the deductible, co-pays, anything else they have to pay, but it can only be used for those qualified medical expenses. So that's a CDHP. Then you've got contributory plans versus non-contributory plans. And by the way, these only refer to group policies. So in a contributory plan, at least 75% of the employees must enroll. So if you have an employee with at least, let's say 100, a company with 100 employees, 75% of them need to, guys, I'm gonna unshare my screen and reshare it real quick. Apparently we're having a bit of a technical glitch, just stand by. Neil, do you see contributory versus non-contributory on the front of the screen?
Now I can see that.
Okay, perfect. Let me know if it unworks. All right, so in a contributory plan, at least 75% of the employees must enroll. So that means if you got 100, at least 75 must be covered. And the employer in that case pays some of the cost, and the employees also pay their share. So like, it just really depends on what the employer has agreed to ahead of time, but that's the structure of this, is maybe they'll pay 100% of the employee cost, and you have to pay everything for the family members, that sort of thing. In a non-contributory plan, every single eligible employee must enroll, 100% enrollment across the boards. This means that the employer pays everything. The employer pays the whole cost, and the employee pays nothing. I've seen this more common in like county, city, government type situations versus the private sector. I know USC used to be set up this way out here in Southern California, but for the most part, what you're going to find is contributory plans. But these are basically the two types of group plans where, remember, contributory, you have to contribute. Non-contributory, you don't have to contribute, and that's kind of, for myself, for the test, that's how I remembered it. If it's a contributory plan, I must contribute. If it's not, I must not. So, but also remember the enrollment requirements. In a non-contributory plan, 100% versus 75 in the contributory plan. All right, deductible. We kind of touched on this a little bit earlier, but we'll get into this a little bit more. When a major medical event happens, a deductible must be paid by the insured. The deductible is basically the amount, your portion of the cost of that, whatever it is. Maybe it's a surgery, maybe it's some kind of procedure, whatever it is. If it's like let's say, God forbid, you're in an accident, you have to be taken to hospital by ambulance. There's going to be a deductible that you have to pay in accordance with that incident or that event occurring. Once the deductible has been paid, that's when the benefits kick in by the provider. So in other words, if your deductible is $2,000 and the whole cost is $10,000, you're responsible for the first $2,000, and then the insurance company pays for the rest. Now, I did jump the gun. So that this third bullet point here, the higher your deductible, the lower your monthly premium, and vice versa. So the more the insurance company knows they're going to have to pay in the event an event occurs, the more they're going to charge you. The less that they're going to pay. So in other words, the more you're willing to pay on the back end. So for someone who doesn't get sick very often, doesn't see the doctor, maybe they just do their annual physicals, that sort of thing, they would tend to want the lower premium, higher deductible. And for someone who uses it all the time, maybe you got a bunch of kids, or kids get sniffles and scraped arms and that kind of stuff. The more you use your health insurance, the more you use your health insurance, then the higher the premium you might want and a lower deductible. Just that's really just going to depend on the individual or family. All right, co-insurance. For every major medical claim, there's a percentage of the cost that you will be responsible for. So for instance, if 80% of the total cost will be paid by the insurance company and the other 20% you will pay. That's called an 80-20 co-insurance plan. I've seen 70-30, I've seen 20-80. I don't know why anybody would buy that, but they do exist. So it's just whatever portion of the percentage of the plan that you have to pay for, that's the co-insurance. All right, now a stop loss provision limits the total maximum out of pocket. So for just to explain this a little bit, you're going to have different deductibles for different aspects of your plan. So you might have a prescription deductible, you might have a hospital deductible, you might have a surgical deductible. There just might be different deductibles. The stop loss provision, also known as the out-of-pocket maximum, is the total you have to pay out of pocket in any given calendar year. So let's say you have a, I don't know, $3,000 premium prescription deductible. You've got a $10,000 surgical deductible and a $10,000 hospital deductible. Well, that's a total of $23,000. But you might have a $15,000 stop loss or out-of-pocket maximum. That means that once you reach the threshold of having paid $15,000 out of your pocket, you're no longer responsible for any of it. And at that point, the insurance company pays the costs and the taps from moment one. Or not from moment one, but from the point where that kicks in. All right, coordination of benefits. So what is this talking about? This applies to cases where someone has health insurance through work as well as individual insurance. Due to coordination of benefits, in this case, group insurance is always going to be the primary. Services not covered by the primary will then be covered by the individual. So for instance, in some cases, people, maybe they have insurance through their spouse at work. And then they also have an individual insurance plan. So the spousal policy is going to cover them first. And then once that's, those benefits have been exhausted, or once they've, maybe there are things that are not covered by that policy, that's when the individual plan would kick in. Probationary period protects the insurer from people who buy health insurance because they're already sick. During this period, there is no coverage for a pre-existing condition that recurs. So let's say, like, we'll use an example myself. I used to have kidney stones. I get them pretty regularly. And so whenever I bought new health insurance, this is prior, by the way, to the PPACA, which we're about to talk about, there was a 90-day period where if I had something occur with health insurance, with kidney stones rather, it was not covered. Once I passed that time period, then it was all good. Because of the PPACA, or the Patient Protection and Affordable Care Act, probationary periods do not apply to medical expense plans anymore. And the simple reason for that is that now they're required to cover people with pre-existing conditions. So there's no circumstance under which a probationary period would occur under the Affordable Care Act and under any medical expense plan. All right, so the PPACA, or the Patient Protection and Affordable Care Act, also known as the Affordable Care Act, or known by its more slang term as Obamacare. The purpose of this plan is to ensure that all Americans have access to quality, affordable health care. This requires citizens and legal residents to have health insurance, and it expanded the Medicaid eligibility, which in California we call Medi-Cal, for people with income up to 133% of the poverty line. So to use simple math, and this is going to be different, there's a federal poverty line, and then there's also state-specific poverty lines. if someone earns $10,000, no, let me back up. Let's say the poverty line in the state of California is significantly higher than this. Let's say the poverty line is $10,000 in income per year. That means someone earning up to $13,300 would be eligible for Medicaid or Medi-Cal in the case of California. So it basically expanded who could qualify for free healthcare through their local state. All right, insurance, part of the PPACA is that insurers need to provide dependent coverage for children up to age 26 for all individuals and group plans. By the way, it does assume that the children up to age 26 are still living in the household, just so you know. But or let me rephrase that, or still being claimed on their parents' taxes. They don't actually have to live there, but they have to be claimed as a dependent. It does specifically say provide dependent coverage. Yes.
I'm sorry, we're still on the probationary period slide.
Really?
Yeah.
I don't know what's happening here. Hang on a second, guys. Sorry, stand by. Getting this reset up. How about now? We're good? Somebody? Anybody?
Okay. All right. So now we're on the Patient Protection Affordable Care Act.
Perfect. Carrying on. All right. So insurers need to provide dependent coverage for children up to age 26. And by the way, if you're taking pictures of these slides, don't worry about it. You'll get the slides once you email what Coleman mentioned earlier, and you get access to all this. So don't worry about rushing to take pictures of this stuff. All right. Through Access for Infants and Mothers, also known as AIM, pregnant women can now get low-cost coverage if they do not already have insurance. So this is pretty huge because it used to be that if someone found out they were pregnant, they basically couldn't get any sort of health insurance. But now, through AIM, worst-case scenario, that they can get access to very, very low-cost health insurance to make sure that they and their baby get the best care possible while they're going through that. All right, the California Health Benefit Exchange. I believe every state has their own health exchange where you can buy insurance. In California, it's called Covered California. The program, yes? Hello? Okay,
Yeah,
moving on.
we're just, there must be a big lag here, sorry.
Okay.
We're good, we're on the right screen.
Okay, good. All right, so the program enables individuals and small businesses to purchase health insurance at federally subsidized rates. So if people qualify for, federal subsidies, that sort of thing, this portal, this website is where they find out how much subsidy they qualify for and all that. So you can also go through a health insurance agent, but this concept will be on your exam. It's called Covered California, and it's basically the web portal where you can go and look up your benefits and that sort of thing and shop for different plans and that kind of stuff. All right, Major Risk Medical Insurance Program, also known as Mr. MIP. The Major Risk Medical Insurance Program offers subsidized coverage to Californians who are considered high risk because of their medical conditions. These individuals are either medically uninsurable or are not able to obtain adequate coverage. This is funded by, and don't anybody go political on me, we are only talking here about what is going to be on the exam. These are the things you're going to need to know. It is funded by the tobacco tax in California. I don't smoke anymore, but I'm pretty sure we're paying somewhere around, I don't know, $10 a pack out here for cigarettes. And if I'm not mistaken, about $6 to $7 of that is taxes. And those taxes are what funds people being able to get coverage through Mr. MIP. And it will be on the test in terms of A, what it's funded by, and B, what it covers. So make sure that you are definitely paying attention to this. To be eligible for Mr. MIP, you have to A, be a California resident, not be eligible for Medicare Part A or Part B, and Part B, meaning basically you got to be under age 65. You cannot be eligible for continuation of benefits under COBRA or CalCOBRA, and we'll cover what that refers to in just a couple of minutes. And you basically have to be unable to secure adequate coverage for whatever your situation is. There is a 3-month pre-existing condition exclusion in Mr. MIP. So if you let's say you got it because you have cancer, it's not going to cover the cancer for the first 90 days. And when applying for Mr. MIP coverage, the applicant may be placed on a wait list. Any time spent on the wait list does not count toward the 3-month pre-existing condition exclusion. However, and this is important, this will be on your test, if the applicant has been on the wait list for more than 180 days, excuse me, 180 days or more, so basically 6 months, then the 3-month pre-existing exclusion will be waived. So from day one, they will be eligible for coverage at that point. All right, so I mentioned we're going to talk about COBRA a little bit. COBRA stands for the Consolidated Omnibus Budget Reconciliation Act.
I'm sorry, Russ, we're on a green screen again, so we're going to need you to unshare.
Okay. How about now? You're good?
Yeah, I got you on COBRA. Could you do us a favor though? Could you go back to the last slide and say it to us one more time, because we were behind again.
Just on Mr. MIP?
Yeah.
Okay.
This one.
Okay, so basically you have to be, in order to qualify for it, you have to be a California resident. You cannot be eligible for Medicare Part A and Part B. You can also not be eligible for continuation of benefits under COBRA or CalCOBRA, and next slide will explain what that is. And you have to be unable to secure your own adequate coverage. So Mr. MIP, under Mr. MIP, there's a 3-month pre-existing condition exclusion, which means, as I mentioned, if you've got cancer, it's not going to cover you for the first 3 months. And when applying for Mr. MIP, you may end up on a waiting list. Any time spent on the wait list does not count toward the 3-month pre-existing exclusion unless it's 180 days or more. So if you end up on that wait list for 180 days or more, then that will be waived. All right, next on to COBRA. So as I mentioned, COBRA stands for Consolidated Omnibus Federal Reconciliation Act. That's a mouthful. And basically what it is a federal law that mandates, AKA requires, that employers with 20 or more employees provide continuation of health insurance benefits in the event the employee is laid off, the company goes bankrupt, or the hours are reduced. And it basically allows the employee to buy health insurance through the employer, even though the person is no longer working there or is no longer full-time. And basically what the purpose of it is to give you a transition period between old employer and new employer, or old employer and securing coverage on your own. However, this is very important. If an employee is fired due to gross misconduct, COBRA will not apply to them. In other words, they're not eligible. You know, if someone in a finance position, for instance, were to be fired for gross theft or money laundering or that sort of thing, when they are fired, they would, excuse me, not be eligible for COBRA. But it's basically, it's a very nice thing, and it's, you know, the cost does go up to the employee, but it does give that person the ability to continue that health insurance coverage. Let's say they're already under some sort of treatment plan or something like that, or they have a family member that is, it allows them to continue that without any sort of a break in that coverage or treatment. Let's check here, make sure we're still on. Okay. CalCOBRA applies to employers rather that have between 2 and 19 employees. It is effectively the exact same thing as COBRA. The only difference is it takes care of the little guy, maybe the small restaurant that only has 4 or 5 employees, that sort of thing. So COBRA, just for your test purposes, is 20 or more. CalCOBRA is 2 to 19. So just you'll need to know that for the purposes of your exam. All right, certificate of insurance. My broadcast is stuck. I stopped sharing the screen. All right, so certificate of insurance. Each employee in group health insurance, you don't actually get the policy. What you get is a certificate of insurance. And a certificate of insurance clearly states that the employee and perhaps their family, depending on who they bought coverage for, has coverage. The master policy, so in an individual plan, you get the policy. In a group plan, you get a certificate of insurance, and the master policy always goes to the employer, because the employer is the one that manages, makes changes to the policy, all that kind of stuff. All right, Medicaid, also known in California as Medi-Cal. I'm not sure what it is in New York, but it just varies from person to person. So in California, like I said, it's called Medi-Cal. To qualify for it, you have to meet the federal government poverty guideline. And you can, a simple Google search will tell you what that is, but just so you're aware, you have to meet the federal government poverty guideline. And the bigger your family is, the more that you can, more that you can make and still qualify for it. All right, accidental death and dismemberment. You'll hear AD&D, which also stands for accidental death and dismemberment. This is the only health insurance that actually has a death benefit like life insurance. It covers accidental death only. So for example, travel accident insurance, which is sold at airports. Also an example, death due to a car accident. Now this is very important, and this, by the way, guys, I'm going slightly off topic for just a second, but I want you to be aware of this. You will sometimes run into people that'll tell you, oh, I have life insurance through my work. And they'll tell you they're paying $2.18 a month for a $500,000 death benefit. I can almost guarantee you that in 100% of those cases, what they have is not actually life insurance. What they have is accidental death and dismemberment insurance, which only covers you if your death is the direct result of an accident. So keep that in mind when you meet with people, as once you get licensed and you're out doing your field trainings and that sort of thing, that because someone says they have life insurance, if it's that low cost, it's probably not actually life insurance. It's probably just accidental death and dismemberment. So just keep that in mind. It gives you the opportunity to explain and educate them on what they actually have. All right, disability income insurance. Type of health insurance that protects against loss of income due to an illness or injury. When a person becomes disabled, he will receive payments from the insurance company that will be equal to or close to their monthly income. Let me see if I'm jumping the gun here. All right. So there's one major company that is known to many, many, many employers, and I will give you a hint. It is represented by a duck. If you haven't figured it out by now, which most of you probably have, Aflac is one of the bigger ones on this subject. And there are, there's a total disability. In disability income insurance, a person is considered totally disabled if they are not able to perform their own job or any occupation for which they are suited by training, education, or experience. So let's think of an example for this. If someone is a stuntman and they've gone to school to be a stuntman, all they know is being a stuntman, and they become totally disabled, or they are no longer able to be a stuntman, then this would kick in. This talks about a dentist who can no longer practice and also cannot teach at a university because they are disabled. Presumptive disability is disability due to loss of sight, hearing, speech, or any two limbs. So it could be both arms, it could be both legs, it could be one arm, one leg, and it's just sort of presumed that the person is going to be disabled and unable to do what they need to do from that point forward. All right, so in disability period policies, there is a period called an elimination period, also known as a waiting period. This is the period of time that the insured must wait before the benefits kick in. So typically the waiting period is 30 days, but the client can choose the length of time. The longer that you wait, the cheaper the policy is going to be, because it's less time that they have to pay the benefits. I was just told the screen didn't change. This is driving me crazy. Sorry guys, I truly apologize for this. Thank you, Olivia. So as I said, the waiting period is typically 30 days, although it can be longer. You can do 30, 60, 90, 120. You can also do a 0-day elimination period, but that would give you the highest possible cost. All right, so in disability income, benefits from disability income policies are taxable if the employer pays the premium. So if you have a disability policy through your employer and you're not paying for it, when you get those benefits would be taxable. They're not taxable if you pay the premiums yourself, or let's say you just go get your own policy on your own and you're just paying those premiums. Then if you get a check for $1,000 a month, that's not a taxable check for $1,000 a month. So it's versus the employer paid plan, then if you get a check for $1,000 a month, it's more like $300, or sorry, $700 after Uncle Sam takes his cut. All right. So coordination of payments. In some cases, a person may qualify for workers' comp or Social Security, disability, that kind of thing. So because insurance companies don't want to over-insure, the payment sent to the client must be coordinated. It means that the disability income will always, the individual disability income will always pay first. So that will always be, the first benefit the person receives. And then if someone has Social Security or workers' comp or that sort of thing, and let's say those benefits run out, then once those are run out, then this individual disability policy would start paying again. So the benefits will always be coordinated with each other to make sure that the person isn't, the idea behind insurance is not to make someone rich. The idea behind insurance is, remember, we talked about this indemnification. Jamie talked about that in the first section, returning the person back to the original state that they found themselves in. All right, SSDI also provides coverage. It is incredibly difficult to qualify for this program due to the strict definition of total disability set forth by Social Security Administration. Now, I would even take this a step further and say that I have known 4 people in my family who have applied for this. All 4 were initially declined. All 4 took some fighting, but they were able to get it. I believe, and don't quote me on this, I obviously their mandate is to decline all claims and see who keeps fighting for it. But nevertheless, when it says incredibly difficult or very difficult, it is very, very, very difficult because total disability means the person cannot perform any work. So, and the disability is expected to last at least 12 months. So you literally, have to be physically unable or perhaps mentally unable to do literally anything. And there's a 5-month waiting period. And you must be under age 65. Why? Because at 65, you're eligible for full Social Security. But again, these will be on your test. So you must be unable to perform any gainful work. It has to be that the disability is expected to last at least 12 months, a 5-month mandatory waiting period, and you must be under age 65. To fully qualify for full disability under Social Security, you must be fully insured, which means you are considered fully insured when you have accumulated 40 quarters of coverage. What does that mean? You have to have worked for 10 years. And the way you accumulate quarters is by paying your FICA, which is basically your Social Security tax, which automatically comes out of your paycheck. If you're on a W-2, if you're on a 1099, that's something you're responsible for taking care of yourself. All right. The Social Security blackout period is the time interval between the date survivor benefits end and the date the benefits resume. Survivor benefits are paid only as long as a parent cares for a child less than 16. Once that child reaches 16, survivor benefits will stop, and the surviving parent must wait until they are at least 60 before the survivor benefits will resume. So I'll give you an example of this. We have a friend who her husband passed away when her oldest child was 4. So for every month while those kids were growing up, she received a monthly check for each of her kids, as well as for herself. The oldest one turned 16, that check stopped. Then the next one turned 16, and that check stopped. Then the next one turned 16. So now she no longer gets any sort of benefits for them. And now, they're in college doing their own thing, but nevertheless, and then once she reaches age 60, because I want to say she's in her mid-40s at this point, then her survival benefits will again pick back up. All right, now we're going to talk about Medicare. Hang on, let me just hop over here real quick. I'm just going to. Brandon, to answer your question, yes, the slides will be, you can have access to these slides. All right. Moving along. Medicare is a federal health insurance program for people age 65 and older. People who are receiving Medicare benefits are called beneficiaries, not to be confused with a life insurance beneficiary. Part A is free for anyone who is 65 or older, and what it covers is hospitalization, nursing care, hospital care, and blood transfusion. It does have a deductible and a co-insurance, just like any health insurance plan, but the premium itself has been paid for by the person the whole time they've been paying taxes and by their employer their whole life. And remember, you got to be 65 or older to qualify for Medicare Part A. Part B is optional, although I strongly encourage anyone who is eligible for this to definitely take part in this. Part B covers the doctor services. So if you notice, Part A covers the hospital, skilled nursing, hospice care, and blood transfusions, but it doesn't cover any of the doctors. That's where Part B kicks in. And unlike Part A, it's not free. But when someone enrolls, they don't have to actually write a check every month. The fee is automatically reduced, withdrawn from the person's Social Security check. It also has deductibles and co-insurance on Part B. Part B, the co-insurance amount is 80%. So you, as the insured, the beneficiary, will be responsible for 20% of the cost associated with that. Part C is also known as a Medicare Advantage plan. Many insurance companies have contracts with the federal government to offer Medicare Advantage plans. Through Part C, I like to call it sort of the fill-in-the-gap coverage. It basically covers everything not covered by Part A and B, with the exception of prescription coverage, which we'll get into in just a minute. The person cannot get extra coverage that can get extra coverage that Part A may not offer. And the same benefits that are offered in a regular HMO and PPO will then be offered through a Medicare Part C. So as I mentioned, I like to call it the sort of the fill-in-the-gap plan. And it's also not free. I want to say my parents, and everyone's parents, depending on their age, are paying about $150, $200 a month for their Part C plan. And by the way, one thing to note is a Part C is a Part C is a Part C. Shopping this type of thing around does not have any benefit to it because they're all the same pretty much wherever you go. And Part D is what covers prescriptions. There's a government-approved list of drugs called formulary or a preferred drug list, and the prices are negotiated through the plan. And the insured is also responsible for deductibles and co-insurance, but signing up for Part D gives you significantly lower cost coverage and lower cost prescriptions than if you just decided, you know what, I don't need it, I'm going to go buy my prescriptions on my own. It dramatically helps offset those costs. All right. California's Health Insurance Counseling and Advocacy Program, also known as HICAP. They provide free education and consumer advocacy programs for who? For seniors. It is a volunteer-based program that helps individuals in selecting Medicare coverage. They do not sell insurance at all. All they do is provide counseling and advice. So this would be for, let's say, your mom, your dad, your whoever doesn't really know, wants some help, wants some guidance. This program exists specifically to help them and at no cost to them. And they're not going to walk in there and be sold something. They're going to walk in there and get guidance and help and advice. All right, Medicare coverage. If an individual is over the age of 65 and has individual health insurance through work, Medicare coverage then becomes secondary. So the primary insurance will always be the individual or private insurance. If the insurance through work does not cover all expenses, then Medicare will supplement the cost. So it's very important to note, if you have an employer, you have a client that's 67 years old and they're still working, they still have their health insurance through their work, the Medicare will become secondary to whatever their primary insurance is through their work or through their spouse or whatever that may be. Long-term care. Now, we talked in the very beginning about the different types of things that you can do with a health insurance license. Well, many of you and many of us may never sell an individual health insurance plan, but what you're going to do is offer life insurance that gives you the ability to add a rider, as Jamie was talking about earlier, for long-term care. Now, all the reasons for this are there's many. Number one, that the premium is fixed and permanent. So once you add that on, it can never go up. Or assuming it's structured properly and the client's putting sufficient money into it, it can never go up. And it basically gives that person the ability to have a death benefit if they pass away, cash value if they need it, if they're perfectly healthy, but the long-term care living benefit if basically they're sick, they can't work, they can actually access a portion of the life insurance as a long-term care benefit. You can also sell standalone long-term care, although I'm sure, I can't say I'm sure. Talk to your SMDs about this, but like for myself, I much prefer doing it in a bundled package with a life insurance policy because it just, they get significantly more benefit for that. So that's one of the things you can do with this license. What is long-term care? Long-term care refers to a collection of services that are intended to meet medical and non-medical need. Well, Russ, I already have health insurance. Health insurance covers the care. What it doesn't cover is someone to help take care of you. If you need home care, that sort of thing, medical transportation, all that kind of stuff. It is a type of health insurance, and they are purchased because typical medical expense policies do not cover non-medical needs. So what I just said in different words. Medicare does not provide any any LTC coverage, but Medicaid does. So Californians, it's Medi-Cal. For those of you in other areas, whatever your local version of Medicaid is, does cover LTC. Medicare, so 65 and older, it's not covered as part of it. So it's definitely very important that we make sure our clients have that LTC in place. The ideal candidates for LTC policies are middle-income families. Why? Because the super, super, super poor are on Medicaid or Medi-Cal, and the super, super, super rich have the cash to make sure they can afford those things. So it's really for people that, in that middle area are the ideal candidates for long-term care policies. It covers the cost of custodial nursing care, skilled nursing care, home-based care, hospice care, and respite care. Respite is rest for a caregiver. So let's say, you have your wife is a nurse and she's taking care of you 24/7 and she just needs some time. So respite care would give you the ability to have someone come in to cover her so she can get some rest, take a shower, or go get a manicure, whatever it is, and you can have that person. All right, and then by law, residential care facilities must be covered under LTC plans. So what that means is residential care facilities are licensed facilities that provide care for the elderly. These are like your nursing homes. They provide ongoing care for those who are not able to care for themselves. And all LTC plans must include coverage for residential care. All right, now, to qualify for benefits under an LTC plan, you must be able to unable to do at least 2 of the 5 activities of daily living: bathing, dressing yourself, feeding yourself, walking, and just general ability to take care of oneself. California, they added a 6th to this, but don't worry about that for the purpose of the exam. They're going to talk about the 5. So, but the important thing to know is that what's the number that you have to be unable to do? It's 2 of these 5 that you have to be unable to do. All right, and just like in disability, LTC has a waiting period. Typical is 30 days. I believe for most of the ones that we sell with the life insurance policies, it's 90 days. But it's just basically a time that the person has to wait before the benefits will kick in and will be available. All right, just like in life insurance, there's a free look period. Same as in life insurance, it's 30, for everyone it's 30 days. For people over 60, it's 30 days for life insurance, but for everyone it's 30 days. So what that means is the client, you deliver the policy to the client looks it over and says, nah, I don't want it. They've got 30 days to return the policy for a full refund. It's not prorated, it's not minus costs, it's not minus fees. If they gave you a check for $400 and they decide in the first 30 days they don't want it, then they get back a check for $400. Pretty simple there. Now, sometimes a client may want to change their long-term care. It is illegal to replace a client's long-term care policy more than 2 times in a 12-month period. So the client buys a policy in January, then let's say in June, they decide, they bought it from someone else in January, let's just say. You meet with them in June, and you're like, you know what, there's a better policy for you, and you replace it. Then you meet with them again in October, because another new policy has come out that's better, and you replace it. One more time to replace that policy, and you've just violated the law. So make sure that, when you meet with someone, if you are going over, by the way, this will be on the test, but also if you meet with someone and they have a long-term care policy, find out how long they've had it, because it's important to know that you're not replacing it more than twice in a 12-month period. Qualified LTC versus non-qualified LTC. So you notice looking at the slide, the words on top are in red, which means this whole concept is going to be on your exam. Qualified LTC policies allow for deduction of the premiums as well as the benefits are non-taxable. On a non-qualified plan, the premiums are not tax deductible and the benefits received from the non-qualified contract will be taxed as ordinary income. So qualified, it's tax benefits on both ends. Non-qualified, it's non-tax benefits on either end. So just keep that in mind. That will be on the exam. Workers' comp and 24-hour coverage. So workers' comp has a compulsory workers' compensation law. Basically what that means is it provides workers' comp provides coverage for someone who has suffered an injury or illness resulting from job-related duties. So this isn't, they were changing the light bulb at home, they fell off a ladder and broke their foot. This is they were changing the light bulb at the office, fell off a ladder and broke their foot. Or maybe they lifted something that was heavy or whatever. They work with chemicals and they got sick, something like that. Under any of those circumstances, workers' comp would pay. Part 1 of workers' compensation, basically it's coverage for the medical bills, the rehab, the loss of income, the death, and the survivor benefits. Part 2 is the employer's liability. So that's the the sort of the punitive aspect of workers' comp. So if maybe it was due to unsafe working conditions, then that would pay an additional benefit beyond just the I lost I can't work or I have to go see this doctor, that sort of thing. 24-hour coverage is basically a circumstance where, by the way, employers with 2 or more employees are required to have workman's comp. 1 or more employees are required to have workers' comp. So if an employer has workers' comp and they have benefits, health insurance during the day, that would be called 24-hour coverage. It's basically there's no point in time that an employee is not covered under their employer's plan, and that's called 24-hour coverage. All right, then laws impacting health insurance plans. You have ERISA, or the Employee Retirement Income Security Act. ERISA requires employers to provide their employees with plan information, including features, benefits, tax consequences, etc. ERISA was created to protect plan participants and beneficiaries. It's basically largely for the purpose of disclosure. So basically lets that employee know everything there is to know about, what the deal is with their plan. This would also be retirement plan, that sort of thing, what benefits they're going to get from it, and also what the tax consequences are going to be. HIPAA stands for Health Insurance Portability and Accountability Act. HIPAA protects health insurance coverage for workers and their families when they change jobs. So to qualify for HIPAA, the employee must have had 18 months of continuous coverage in a group plan. Also, while changing jobs, the employee cannot be uninsured for more than 63 days. I'm gonna wonder where they came up with some of these numbers. So under HIPAA, if you already satisfied your probationary period for a given condition, in the new group plan, your pre-existing condition will be covered immediately. This is going to be on the test. The test is a little bit outdated in some places, but remember, the Affordable Care Act removed the pre-existing condition, so it's not going to be an issue. So basically, but you need to know that for HIPAA, you must have had 18 months of continuous coverage and that the employee cannot be uninsured for more than 63 days. All right, so we're going to jump into annuities real quick. Michael, are you still there? All right, good. I will cover some stuff on annuities here real quick, and then we'll bring Michael back on. Give me 1 second here. All right, so many of you have heard the term annuity. Maybe some of you haven't heard it at all. So this illustration kind of gives you a very, very simple explanation of what an annuity is. So you have some money sitting somewhere. Maybe it's a 401k. Maybe it's a savings account. Maybe it's a CD. Maybe it's an old IRA. Maybe whatever. Just you got a bunch of money sitting somewhere. You give that money to an insurance company. The insurance company then says, okay, we're going to give you a contract. And in that contract, we're going to guarantee that you have an income stream for life. This is basically guaranteeing you're never going to outlive your money. It says right here, an annuity is a contract between you and a life insurance company. When you purchase an annuity, you give a lump sum of money to an insurance company, and in return, they promise to pay you a guaranteed income stream for the rest of your life. It says you cannot Under any circumstances, okay, out of the under any circumstances part, but you cannot outlive the income that you receive from an annuity. So why is that a good thing? First of all, let's talk about this for a second. Let's say someone has $500,000 sitting in a 401k, and they need to pull out, let's say, $25,000 a year. They want to retire. They're going to pull out $25,000 a year to pay their expenses. Well, simple math. Let's say there's 62 now. If they pull out $25,000 a year from that IRA, then they're going to run out of money in 20 years. That's simple math. They'll be broke in 20 years. With an annuity, there's an insurance component to it, so that basically they're saying, Mr. and Mrs. Client, no problem. If you outlive that $500,000, you will continue to get that $25,000 a year for as long as you live. Pretty cool. Pretty good stuff. The income that is received from an annuity is taxed. A portion of it, depending on the type of annuity, that's a whole different conversation that we'll get into in a different class. And annuities are generally used for retirement purposes. Annuities are the exact mirror image opposite of what a life insurance policy is. In an annuity, life insurance creates an immediate estate. So someone passes away, they had a $500,000 life insurance policy, instantly you have a $500,000 estate. Annuities are exactly the opposite. The annuities are the bleeding down of the estate. So every time you take a withdrawal from that annuity, the estate is getting smaller. In an annuity, you name a beneficiary. In annuities, the beneficiaries are taxed. In life insurance, the beneficiaries are not taxed. So a check for $500,000 from a life insurance policy is $500,000 to your beneficiary, and it's all tax-free. If the client receives or the beneficiary receives a check for $500,000 from an annuity, depending on the structure of the policy, a portion of it is sure to be taxed. How much of it is going to be taxed depends on the type of money it was and that sort of thing. But there are taxes associated with annuity beneficiaries. And it doesn't matter what your health is when it comes to an annuity. Anyone can buy an annuity. It's really about financial qualifications and how much money the person has. All right, so just like a life insurance policy, an annuity has a beneficiary and an owner. However, in annuities, you do not have an insured, you have what's called an annuitant. That is the person that receives the income from the annuity. Sorry, forgive me. You do have a beneficiary, but the beneficiary is who receives you don't have an insured in an annuity is what I meant to say. You have an annuitant. That's the person that receives the income from the annuity. The owner and the annuitant can be different people, and the owner can make changes to the contract, but the annuitant cannot. So let's say a spouse buys an annuity and they are the owner and the annuitant is their spouse. Let's say a wife buys it on a husband. The wife can make changes to the contract. The husband cannot. And the death benefit paid to the beneficiaries of an annuity can be taxable. Like I said, it just depends on the exact circumstances. All right, two types of annuities. There's an immediate single premium annuity where basically you put in, using the example I gave, client puts in $500,000, and after a month, they can start taking income out of that annuity, probably $25,000, $30,000, depending on the contract. So, and then they get that check monthly, they can get it quarterly, they can get it annually, but that's a single premium. You cannot add more money to that type of annuity on the immediate basis. A deferred annuity, there can be a single premium deferred annuity. There can also be a flexible premium deferred annuity. In a single premium, let's say they put in the $500,000, they're not going to want income for 10 years. So that $500,000 after 10 years is now $1 million. And then they start taking income based on $1 million. A flexible premium is one that they start out with a lump sum, and then they can add more money down the road up to the point where they're taking income from it. And that's why it's called a flexible premium, because it gives you the ability and the option to add more money down the road. In an annuity, there are two phases. You've got the accumulation phase, and then you've got the payout phase. At any given point in an annuity, you're in one or the other. It'll also be called, by the way, for the purpose of your test, the distribution phase. You can't be in both phases at the same time. So once you're taking money out, you can no longer put money in. In the accumulation phase, that's when your money is growing. That's when it's earning interest. In the distribution phase, the insurance company is giving you your money back. So they're paying you income either as a lump sum or monthly or annually, but that's when they're getting the money back to you under those circumstances. So there are two phases to an annuity. Remember that. You've got the accumulation phase and you've got the distribution phase. So the process of converting an annuity contract into a series of periodic payments, income payments, is called annuitization. They may be annuitized regularly over a short period of time, or in some cases in one single payment. So you can also choose the time period. So let's say you're like, look, I want to annuitize this thing. I only want income for 10 years. You can structure it so that you only get income out of it for 10 years. The regular annuity is basically you're turning on the income, and that's going to pay you for life. But you do have some flexibility with how you annuitize. But the concept of annuitization is converting the contract into a series of periodic income payments. So the way annuities pay interest, you've got a fixed annuity, which pays a fixed rate of return until you start taking income. It's generally guaranteed and cannot change. So I may be wrong about this. The best fixed product I'm aware of right now is paying close to 3%, which means you are guaranteed to get basically 3%, but it's never going to do more than that. In that type of annuity, the funds will go into the insurance company's general account. This is going to be on the test. In a variable annuity, the funds go into a separate account, and those funds are invested in the stock market. They may lose value, but they can also have potentially higher rates of return on the money. You do need a securities license to sell a variable annuity, but remember, fixed annuity, the money goes to the general account. Variable annuity, the money goes to a separate account. And then you've got indexed annuity, which, by the way, you can do with the license that you're all studying for right now. This one basically guaranteed never to lose money. Typically, there's a floor of 0. And in most cases, they have caps, somewhere between 5 and 7%, but there are products that exist where the earnings are uncapped. The principal is guaranteed, but the interest rate will change depending on the index performance. So, you might have one that averages 4, 5, 6, 7, 8%, depending on the product. Some might have a cap, some might not. But if you have a client that is interested in gains, but also interested in completely eliminating their risk, then an indexed annuity might be the right thing for them, depending on their situation. All right, so you can annuitize. Some of the options in an annuity are pure straight life annuity, which pays until the person pays until they live. It pays as long as they live. Once they die, there are no more beneficiary payments. Sorry, there are no more payments, and the option does not have beneficiaries. So basically, this would give you potentially the highest income option. And if there's money left over in the contract, then the insurance company will keep the contract. Sorry, keep whatever's left over. So a person has $500,000 in their product. They take $300,000 out, and they pass away. The insurance company is going to keep the other $200,000. With periods certain, the payments are paid out during a set period of time. If the annuitant dies during that period of time, then the beneficiary gets the difference of what's left over. Hang on one second, guys. But if the annuitant lives after 10 years, they continue to get paid. So the minimum guaranteed income period is 10 years. And when I say minimum income, if they die after 1 year, then the beneficiary will get the total of what they would have gotten over the 10-year period. But if they live longer than the 10 years, they continue to get that income until they pass away. Just at that point, there's no death benefit. Refund life, that's basically the insurance company refunds whatever's in the contract. So it says here an example. In a $100,000 annuity, the annuitant receives $75,000 but then dies. The beneficiary then gets the $25,000 difference. In a refund annuity, the client can receive more than $100,000 in income, but there will be no refund to the beneficiary if the annuitant receives more than their initial investment. So let's say the person has $100,000 and then they receive $125,000 over the lifetime of the income. Then when they pass away, there would be nothing for the beneficiary. But if they only received 75, as it says in the previous example, then the additional 25,000 would be returned to the beneficiary. Okay, so like it says here, unlike unlike life insurance, the annuities are taxable. And then the taxes on the annuities depend on the source of the funds. If it's qualified money, that's money that's never been taxed. So that would be a 401k. That would be a 403b. That could be a traditional IRA. In a non-qualified annuity, that means that the money has already been taxed. And this could be just money you have sitting in a savings account. It could be a checking account. It could be, money that you already inherited that was already taxed. So it just really depends on how that is structured and how where it was taxed. So on a qualified annuity, the dollars are taxed from $1 because you've never paid tax on any of that money. So if you, let's say you rolled over your 401k into an annuity and you start taking, as it says here, $5,000 a month from the annuity, you're paying taxes, ordinary income tax on every dollar of that $5,000 a month. If it's non-qualified, the client uses after-tax dollars. The initial investment is called the cost basis. So the $100,000 basically, and then I skipped that slide because this one has more of the guts on it. So I buy a $100,000 annuity, and by the time I take the income stream, it's now valued at $150,000. That means that the cost basis is 100, and the other 50,000 represents interest that's been earned. So 33% of the income from that the annuity is subject to income tax. The other 66 or 67% rather is not. So on a non-qualified annuity, the insurance company figures this all out for you. So I don't want you to worry about having to be a math expert to make this happen. They have a formula that will tell you the portion of the income from a non-qualified annuity that's going to be taxable. All right, guys, so I'm going to jump up.
I'm sorry. We just now got that screen that you were explaining. Would you mind doing it one more time with us, please?
No problem. So if you buy a $100,000 annuity, by the time you take income from that annuity, it's now valued at $150,000. So your cost basis on that is $100,000, which means basically once you start taking income from it, because $100,000 is your cost basis, $50,000 is your gains, only the portion of the income from the gains is considered taxable. So that basically means 33% or 1/3 is taxable income. So every time you receive income, you will pay income tax on 1/3 or 33%. The other 67% is considered to be non-taxable because it's your cost basis. All right. All right, guys, I'm going to jump off. I'm going to turn this back over to, honestly, the person who's taught me everything I know. And as I mentioned earlier, we are super, super excited to get him up to his $1 million ring, which we will have done, Michael, in the next couple of pay cycles.
Yeah.
I am grateful to be in business with him. I am grateful to have learned from him, what he has learned over his time in this business. He is honestly one of the best people I know, just in terms of heart, integrity, courage, stick-to-itiveness, and I'm grateful for you. So Michael, back over to you.
Hey, Russ, can you hear me?
Yep.
Okay, stop your share because I have to be able to share my screen.
Working on it.
Okay, good. Ah, look at that. All right, guys, we are at the tail end, and I'm going to go ahead and share the last little bit here. And I got to tell you, thank you, Russ, so much for going through that. That was incredible. And let me just go ahead and get my the last couple slides here up and running. And I'm going to share the screen. But hopefully, you guys, this has been good for you as far as. Let me see, is this going to work? Okay, there it is. Hopefully this has been good for you as far as like all the education, the proper way to educate everyone and how to roll this out as far as licensing is concerned. This is really going to be something that I think that if we duplicate this well in our offices, Jamie and I actually just got off the phone and we were talking about, potentially taking this recording and being able to slice it up. And so then we're literally going to be having people that are proctoring it, and we can just go through each section. We're going to have it structured in a series of videos that you can actually just roll through, proctor it, and just get tons of people through licensing. Okay, so I'm excited about that, and and I wanted to close this out strong. There's only a couple other slides left. So the thing about this here is, again, this slide is not going to be on your exam, but it's going to be sort of a rule of thumb. And again, this is every annuity and every product has a different commission structure. If you go into WFG, we literally have hundreds of products, from dozens of different providers. So annuities are one of the hottest financial products because it addresses most of the baby boomers' retirement needs. So let's say you roll over $150,000 from a 401k into an annuity. And by the way, when I got started, we were doing about $1 million per quarter of total rollovers in the entire hierarchy of Team Revolution. When I first got started, it was about $1 million per quarter. Now, just in our organization alone, we're doing a couple $1 million per week, right? So imagine that. we're moving on average, you know, I don't know, 50 to $100 million a year into these annuities. People really want these products, and they want to be able to understand them and avail themselves of the wonderful benefits that are in there. Now, obviously, you've got to know what you're doing, and your field trainers are going to be walking you through this. But I wanted to give you a little bit of a flavor of what you can potentially make by sitting down and doing one of these, okay? So $150,000 gets rolled over. You know, we wind up making on the gross, you know, amount that's paid out for having found that customer is about 6%. So 150 grand is going to be about 9,000 points, right? Or total gross commission. So at your percentage level, if you just got the license and you opened up one of these accounts, you're going to make 2,250 at our lowest contract level. As an associate, you're going to wind up making $3,150. At a senior associate level, you're going to wind up making $4,000, you know, $4,050. At a senior marketing director level, you're going to make $5,850, right? And so I think that that's awesome. And, you know, and so obviously, again, would you rather make 2,250 or would you rather make 5,850? Stupid question, but I'm telling you, it's a rhetorical question. Obviously, you want to be able to do that. So you need to understand how to build. The other thing too to remember is that, you know, you also have to understand how our system works, because of the fact that, you know, you may be at a marketing director contract. You may go, well, is there something better than 65%? That whatever. If you have any licensed people on your team, you're automatically making more. I did a calculation that, you know, we had, I don't know, maybe 1,000 licenses and an average of 5% per license. That's, what is that? That's 5,000% plus my 65. So that's why I'm not recruitable by other companies, because my contract level is 5,065% and I don't have to do all the work. So this is one of the reasons why we want to build teams and so forth. But I just wanted to give you, again, a flavor. What if you had someone that had $1.5 million that they were going to do? Add a zero to all of these. So you could make $58,000 just for helping someone move $1.5 million. And there's tons of people that need these rollover accounts now. It is awesome, right? And I'm going to just tell you, I plug for the securities licenses. I think people should get that because it gives you more options of being able to do some of these things, which is great, okay? So with that being said, is that, okay, so in annuities, you're considered a senior if you're over the age of 65. In life insurance, you're considered a senior if you're over the age of 60. So remember that. Life insurance, 60. Annuities, 65. The free look for seniors is 30 days. For non-seniors, it's 10 days. And that's both in life insurance and annuities, right? This is something that I want you to remember, is that the business that pays is the business that stays. Make sure that you're doing needs-based planning, finding out exactly what they need, and then doing that thing and delivering them the product and service that's going to fit their needs and is going to be in their best interest. One of the things that's going to be happening over the, you know, the next couple of years is that the entire financial industry is going to a best interest, basically standard, which means that the things that we're going to do are going to be in the best interest of the client. Now, I want you to remember that we're going to have, like, you know, software and capabilities of being able to measure, what's in the best interest, and it'll show that you've done your due diligence. So these are all things that are going to be being taken care of. Your job is to just get the license and get out in front of people. So annuities, annuity rules, not to forget, annuities, right, have a 59.5 age rule. If the annuity touches their money before the 59.5, age 59.5, they're going to have to pay a 10% penalty plus taxes. So the age 70.5 rule also applies. So the client must take withdrawals from their annuity contract before the age, or at the age of 70.5, or they will be penalized 50%. So I just want you guys to understand that there's something called a required minimum distribution. The required minimum distribution states that age 70.5, the money inside of an annuity, because you have not touched it, the IRS wants their piece. The government wants their piece. So you get to 70.5 and you go, oh, I don't need the money. I'm just going to let it, ride, up and just give that to my kids, or, have it be a death benefit. The IRS said, no, I'm sorry, but that does not work for us. We need the money. give me the cash, right? That's what they're saying. So 70.5 rule applies. So you want to make sure that you understand that is that once your clients approach 70.5, they're going to need to start taking that money out. Okay. So with that being said, I wanted to tell you, I think that we're done on that. So I'm going to stop the share. I'm going to come back over here. So with that being said, I wanted to tell you, make sure that you maintain a positive attitude. Make sure that you understand that, you know, if you wind up not passing, it's not the end of the world. You just got to jump back on the horse. I will let you know that once you go through, if for some reason, and by the way, just by going through this webinar, this Zoom webinar, your chances of passing the test have exponentially increased just because you took this. Okay. So if by some chance you wind up not passing the test, my recommendation is to immediately figure out the next, like you could take it the next day, like tomorrow or the day after. Don't wait for weeks and weeks and weeks and go back and, you know, lock yourself in your house and study for the next 2 months. Get back in there, and now you know what you're supposed to do and you have the rhythm of it, and just go take the test as fast as you can. Okay. So let's see here. So by the way, if you want these slides, I'm not going to answer the email, by the way. What it is I'm going to send it again to you, to all recipients. Base shop at mcoleman.com. Okay, that's the thing. And the subject, you must write this in the subject line. It's Revolution Licensing. Okay, Revolution Licensing. Base shop at mcoleman.com. Subject Revolution Licensing. You will get all these slides. They'll just auto respond right back to you. Remember, this is just one agent to another sharing my notes of what I studied when I was going through this stuff. So I want you to understand that. So with that being said, I think that is pretty much it. Let me see, is there any other stuff that I needed to go over? No, I don't think so. So guys, get out there, get lots of licenses. Let's drive the licensing through our entire teams. We want to be able to get you guys out there making money. I want to be able to help you guys as much as possible. Whatever you guys need from me, obviously, I'm happy to give tips. All the SMDs have my contact information. So, you know, SMDs, if you need help or tips on how to implement this into your hierarchy or into your organization, please don't hesitate to call. I'm super happy to be able to do that. I want Team Revolution to be the #1 team. We got to get ourselves up to 10,000 licenses as fast as possible. I'm looking for our hierarchy. We're working on tripling in size over the next year. Between now and the end of the year, over the next 11 months, we're looking to triple the size of our organization and get us up to about 2,000 licenses, right? So anyways, guys, you guys are awesome. Neil, I don't know if there's any other stuff that we need to go over, or if there's any other closing messages, but outside of that, I think that we are good to go. So guys, do what you're going to do with this stuff. Go out there, make millions of dollars, and we will see you at the top. Neil, I'll turn it back over to you to stop the recording and close everything out. Thanks guys.
Thank you.
Got it.
Thank you.